It's all about AI.
We're still seeing a lot of strength and a lot of momentum around the AI trade.
Since March, we haven't seen anything that resembles anything sort of a pullback.
Demand is showing no signs of slowing down.
Records will be broke over the coming weeks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, finding a crack in the tech boom. Quarterly results from Broadcom failing short of high expectations as a beat and a raise from CrowdStrike is failing to satisfy big demands, just as JP Morgan's Jamie Dimon is gearing up to pitch the SpaceX IPO to wealthy clients.
Is this supply anxiety coming to the fore a bit in markets? Is it just a sense that maybe we've gone too fast, too hard after a streak that was almost the longest winning streak going back to 1995 in terms of a 10th straight day that we did not make yesterday? Some people saying this is probably a healthy cooling off given the fact that people have already baked in such extreme valuations. It's more about positioning than it is about the results. With the SpaceX issue, though, that's starting to raise questions about supply and demand.
To your point on Broadcom, let's look at it in the pre-market. Down hard in early trading, I get it, but you've got to talk about how we got here. How we got here, going into earnings, Broadcom added $280 billion in 4 days of trading. And based on that move this morning, we're going to take those 4 days back.
And part of this is just that how much are you levering up some of the earnings that you're expecting? I mean, they really did beat expectations in certain areas. There were a couple of small misses. Nonetheless, if you have shares that are levering in so much growth over the next 5-10 years, a small miss or a subdued beat is going to give some people some concerns.
If you're bullish, look at Taiwan Semi and look at the comments coming out of the C-suite this morning. That company is telling everyone that this sector is still supply constrained.
Still supply constrained, and they're saying that they won't be able to meet demand for years to come. Not days, not months, years. And I think this is the bigger story out of all of them, because this is really the crux of the entire AI trade. They have a monopoly, really, when it comes to the supply chain. And if they're saying that they're not going to meet demand for years, well then, why are these stocks down?
We've thrown a lot at this market in just a few days. Think about it. An upsized Alphabet capital raise, not just the 80 billion we were thinking about, make it 85. You've got a mega IPOs on the horizon as well. And by the way, for the year so far, we talked about it earlier this week, we've priced in near record time $1 trillion of IG debt stateside. That's a lot of money being thrown around.
And it's just the appetizer. When you talk to investors, they say, what are they front loading? This is just the beginning of potentially a multi-year cycle of more than $1 trillion of spending over the next couple of years. For now, it's essentially take from this guy, give it to the semiconductors, and that's what seems to have worked. Now people are starting to question, how far can this go? Where is the pricing power? TSMC, yes, they were saying that demand's going to be really great for years to come and they can't meet it, but they also said they're not going to be increasing the prices as much as some other players are going to be increasing them, just simply because they want to create a stable, steady customer base.
So here comes the tighter monetary policy as well. Keep an eye on this. Next week, the ECB is gearing up to hike. The BOJ, according to our sources, also gearing up to hike. And the Federal Reserve, one more Fed official, just talking up the potential for a rate hike maybe later this year.
Yeah, we've been hearing this groundswell, although the fact that they're talking about maybe some sort of rate hike later this year, Beth Hammack leading the charge on that one, it gives you a sense of how far we are away from the ECB, the BOJ, and the U.S., the Federal Reserve, saying we probably should think about not easing. This is sort of giving you a sense of where we are.
A discussion about discussing it at some point in the future.
Exactly.
As opposed to actually hiking it the next week or so. Coming up this hour, we'll catch up with Chris Ferro of Strategas as the tech rally hits some turbulence. We'll catch up with the State Department spokesperson, Tommy Pigott, as Iran says there is no progress in talks. And Angelo Zino of CFRA as Broadcom falls short of some big expectations. We begin this hour with stocks pulling back as earnings from Broadcom and CrowdStrike fail to satisfy investor demands. Chris Ferro of Strategas writing the trends remain strong across the board among the major indices. But there are some blemishes out there that can't be entirely looked over. Chris joins us now for more. Chris, good morning.
Great to be here, John.
Identify the blemishes. Where do you see them?
Yeah, I mean, listen, financials, I think, are the worst performing sector through the first 5 months of the year. So you can't entirely discount that the banks have been a little bit squishy here over the last couple of weeks in particular. We've seen, I think, the consumer finance names start to weaken. I think Capital One, Amex, Synchrony Financial. So there's some blemishes, I think, within financials. The question that I'm trying to figure out are the impaired stocks or the impaired groups, are they weak because they're truly impaired, or are they weak because they're just not AI stocks? And I think that's that's the big question of the moment, because we've been in this highly rotational market. I think that continues, but you do have to just be aware of some of these little cracks around the edges.
What would your North Star be? What would be the tell in the market to back up one versus the other?
So I know there's all this debate on like what level 10-year yields really, are the risk-off signal for stocks. My gut is it's a level that's much higher than people truly believe. I think we learned last week that 465 10-year yields is not enough to disrupt this entire story. And if you kind of go back to past melt-up or past bubble-like experiences, whether it was Japan in '89 or NASDAQ in '99, the level of the bond yield goes aggressively higher. I mean, we saw JGB yields in '89 go 4 to 8. In NASDAQ in '99, US 10s went 4 to 7, right? So I think there's a level materially higher than 460, 465, where you start to really begin to question, is money being treated better somewhere else?
If that's the case, then bond yields aren't close to that, and you can park that for now as a story, as a tell. Yeah. The issue a lot of people are having is, are investors selling the likes of banks and non-tech stocks to finance their purchases of all of these IPOs that are coming to market?
It certainly seems like that, certainly tech or AI has soaked up all the oxygen in the room here. I would be more worried about financials weaker or banks weaker if credit conditions were deteriorating. That's just not the case at all. Whether it's subordinated bank spreads or discretionary high yield, all of these things are at or near the tight. So you're not seeing the knock-on effect in credit, which gives me some comfort that this is not some, systemic problem that's about to weave through the markets here.
Systemic problem is one thing. Overvaluation and being forced to buy a lot of paper that even the CEO of the biggest bank is trying to jam through down everyone's throats gives you a little bit of pause. And that's one of the concerns that people have. They're sort of being forced to buy into something that is becoming the market, potentially the 5th biggest company in the world, in the S&P 500. And all of a sudden, it's sort of like, do we really like what we're being sold?
Well, that's what I think we learned this week. I think we learned this week that the interest rate, the 10-year yield, is not high enough yet to prevent this from happening. So I think we have to find a level on 10-year yield that's meaningfully higher than where it presently is. And I know what we're supposed to think here. I know
what?
We're supposed to, well, listen, I think we're supposed to think that, okay, a deal with Iran gets done and yields go back to where they were pre-war, and oil goes back to where it was pre-war, and the energy stocks all sell off. But that's not what the trends suggest. The trends in global yields are still up, not down. The trends in energy stocks are still up, not down. So I have to kind of be deferential to the trends. So I think ultimately we're talking about a 10-year yield that's probably higher than where we were last week, maybe with a 5 handle on it before all is said and done here.
So you're basically baking in more inflation when it comes to AI trade, also energy. But the Treasury Secretary yesterday once again called it, I didn't think he used the word transitory yesterday, he said transient or a blip. Do you think inflation right now is a blip?
Well, I think it's a mistake to look at the move in nominal yields and think it's all inflation. I mean, look at the surprise index. It's accompanied yields higher the whole way. I mean, there's been a really meaningful growth element to this. 5-year break-evens are frankly back to where they were pre-war. So I think the growth element of this is much more potent than we're getting credit for. And frankly, you see it in the industrial stocks. I mean, the industrials still act well. What names in industrials broke out this week? United Rentals, Grainger, Fastenal, Eaton. I mean, these are not growth falling off a cliff type names.
The bond market just hasn't been a tell for the equity market. Japan's a fantastic example of that. The start of the year, if I turned around to you and said, OK, look, Japanese stocks, they're going to face the following headwinds. BOJ might hike. You're going to see record highs on certain yields across certain maturities in the JGB market. And yet here we are at more than 30% on the Nikkei. What's going on in Japan?
I think it's remarkable, for 30 or 40 years when JGB yields were falling, right? Why do we want to go back to that? That wasn't particularly good for Japanese stocks then. And yet there's all this alarm that they're, 270 here on JGB 10s. Look at the Japanese banks making new highs today. MUFG, new high today. I think we'll get a clue when the move in Japanese yields has kind of crossed the level when you begin to see the Japanese banks weaken. And there's been no evidence of that here yet. Now, when you look at what's driven the Nikkei, up 30% year to date, in an environment where logically you'd say, oh my God, they're in the midst of an energy crisis here. it has been a lot of the same type of stocks that have driven the move here, but they still have the banks working in Japan. I think that's an important and meaningful distinction from what we've seen here.
Do you think that yields really ought to be higher just as a policy response to some of the froth that you're seeing when you're saying that some of these IPOs are getting a little uncomfortable?
I'm not saying they should or they shouldn't be, and they'll do what they ultimately please. But I think at the end of the day, when you're in these melt-up-like environments, you're going to find a level on the 10-year yield ultimately where it suggests there's sufficient competition for stocks. And if you look at this kind of market we've been in, particularly over the last couple of years, money doesn't want to leave the asset class of equities. It's just been sloshing around and rotating from this group to that group. So there has to be some catalyst or some reason why it would leave. And the only thing I can think of is a materially higher bond yield, which we haven't seen yet.
Your point, though, I think is a valid point. This move in bonds is not just about the move in energy. In fact, it might not even be the primary driver. And I think that's the change in fixed income that I've identified more recently, particularly among the Fed officials. I think even if you address the situation in the Middle East, this conversation about rate hikes doesn't disappear overnight. Not in this country.
Especially because of the CapEx spending, especially because of the resilient consumer that we continue to see in all of the earnings, especially because of the manufacturing boom that you're seeing in some of these names. I mean, that all is coming together for that.
You know, I think in this business, there is nothing less satisfying than thinking you got the story right, but losing money. And I think there's nothing more satisfying than, frankly, getting the story wrong, but still making money. And when I think about what we thought this year, you know, we went into 2026 thinking you get a melt up in asset prices because either Warsh or Hassett would be cutting into a very strong economy.
Right.
Clearly, that's not happening, right? We're not going to get cuts into this environment, yet we're having a melt up nevertheless. So maybe this year has been a lesson in the latter, wrong on the story, but right on the market.
Do you want to sound smart or make money?
Yeah, that's an easy call.
The Middle East has been a great example of that over the last few months. There's a lot of reasons to worry. That's not going to help you make money at the moment.
Which is the reason why everyone's going for the make money and sound like,
right.
You know, this is the reason why Chris Verone came up with the mantra of 2026.
The less you know.
The less you know.
It's a great line, the less you know.
Thank you.
Is the client's picking up on that line too?
Well, listen,
it's... Got to park the worries,
think about it.
Put them in a box.
Think about the course of the year. If on February 27th, Lisa, if on February 27th, the day before the bomb started flying, when gold was 5,500, if you would have guessed where it would be today, you would not guess 4,500. You'd guess 7,000. Or defense stocks weaker over this period, or a yield curve flatter.
Energy stocks.
So my point is, the market's always 2 or 3 steps ahead of me or you, right? So let's be imaginative and open to what it's trying to tell us. Maybe gold went down because we learned during this war that energy reserves are more valuable than gold reserves. I don't know. It's an idea. But my point is, the market seems to be ahead of us. Let's just spend more time listening, less time telling it what it should be doing.
The post-pandemic period has been humbling so far. Let's put it that way. Chris, it's good to see you.
Great to see you.
Thank you, buddy. Chris Verone there of Strategas. Equity futures right now in the S&P pulling back by 0.4% with an update on stories worldwide this morning. With your Bloomberg brief, Isabel Lee has more. Hey, Isabel.
Hi, John. The U.S. says Israel and Lebanon agreed to a ceasefire. The White House saying the agreement is contingent on, quote, a complete cessation of attacks by Hezbollah. There has been no indication Hezbollah has accepted the terms of the deal. Broadcom shares falling in pre-market trading. The company delivered a disappointing forecast for AI chip revenue. Broadcom says it's making progress with AI customers, including Alphabet, Anthropic, and Meta. And in sports news, which I believe will make some of you happy, the New York Knicks are off to a strong start in the NBA Finals, beating the San Antonio Spurs 105-95. The Knicks have won 12 consecutive playoff games and are 3 wins away from their first title in 53 years. Game 2 tips off tomorrow night in Texas. That's your Bloomberg brief. John?
Isabel, thank you. One person in particular, of course, wearing Knicks blue this morning around the table.
You have to.
I noticed that. A little bit of a pop and a step this morning too.
I was excited. So I went to bed and it was a rough game, and then I woke up, watched the second half, the fourth quarter. Incredible. Neil Dutta was there, sending me. I woke up to a live feed of Neil giving me the play-by-play.
Yeah.
He's on the Knicks Instagram.
I saw that. He's very happy with that. Have you positioned the mug for the bump out?
Yeah, let's get it.
Okay, get that ready. All right. Up next on the program, mixed messaging on Iran.
In that part of the world, ceasefires when you're shooting in a more moderate manner. The negotiation itself has gone very well, actually. It might not happen, who knows? But if it happens, it could happen like over the weekend.
Up next on the program, we'll catch up with the State Department spokesperson, Tommy Pigott, live from New York City this morning. Good morning. More data coming up later this morning, 8:30 Eastern Time. Another read on the jobs market. Jobless claims just around the corner. Payrolls Friday, the main event tomorrow morning at 8:30. Into that, your scores look like this, pulling back on the S&P. We are down by 0.4%. Over on the Nasdaq, we're down by 1 full percentage point. Broadcom in the pre-market getting absolutely hammered. Talk about lofty expectations. That company falling short.
Yeah, and you mentioned how much market cap they had been adding, and so far this year they're up almost 40%. The fact that they didn't outperform the way that some of the other names have, with beats that have been monstrous. I mean, we've seen some really big beats. They did not do that, and as a result, they're getting heavily punished. And it's spreading to others too. CrowdStrike as well.
Down double digits in the pre-market. More on that name a little bit later this morning. Under surveillance this morning, mixed messaging on Iran.
Is the ceasefire with Iran still on?
Well, you know, there's a reason for everything. And we hit them pretty hard. In that part of the world, ceasefires when you're shooting in a more moderate manner. The negotiation itself has gone very well, actually. It might not happen, you know, who knows? But if it happens, it could happen like over the weekend.
That wasn't a bad definition of a ceasefire in the Middle East, you know.
It's not.
It's like fairly accurate.
When I go to sources and I'm like, how is a ceasefire holding? They're like, Annmarie, it's the Middle East.
Precisely. So here's the latest this morning. The president remaining positive on negotiations as Tehran says there has been no tangible progress. Overnight clashes between Israel and Hezbollah complicating talks as Lebanon's president says a ceasefire with Israel could begin within 24 hours. Joining us now is Bloomberg's Abu Omar from Dubai. Abir, welcome to the programme. Welcome back. Let's get caught up on where we are. Are we making progress? That's the one question I hear every single day on this programme. Are we making progress? Any signs of that this morning?
Well, it's the Middle East is the right sentiment here. A lot of conflicting statements. We're still getting a lot of those. And the latest is still pretty confusing. What we know is that Israeli officials had met with Lebanese counterparts yesterday, and what they reached was essentially talks for Hezbollah to stop its hostilities against Israel and Israel to do the same. So it's conditional. Israel did say that if Hezbollah stops its attacks against the northern part, then Israel would reduce its hostilities. But just about an hour and a half ago, the hostilities remain in the southern part of Lebanon, where Israel has its deepest incursion in about 25 years. And so we're still seeing that the Lebanese president coming out to local media and saying that we may see the truce come into effect in the next 24 hours. But then he also did say that he's waiting to hear responses from different parties. That may include Hezbollah, that may include Israel as well. President Trump, on his own right, did say that we may see broader negotiations between Iran and the United States carrying on this weekend, but then he also said they may not. So we go back to this back and forth that we've been witnessing over the past couple of months or so since the initial ceasefire was put in place. Still wait and see mode, still waiting to see if the truce does come into effect between Lebanon and Israel for the broader interim deal to start being negotiated.
Bear, thank you. Appreciate the update. As always, joining us now around the table, the State Department spokesperson, Tommy Pigott. Tommy, you're the man this morning. Good morning to you. Tell us we're making some progress, because I can tell you, on Wall Street, this is the #1 story that people don't want to talk about right now. Are we moving forward?
Well, look, we're moving forward in achieving the president's objective. I mean, you started saying mixed messaging on Iran, but the president's been clear from the beginning what his primary objective is here. The Iranian regime can't have a nuclear weapon. So we saw Operation Epic Fury, the decisive outcomes from that. We're seeing in Lebanon and Israel, those talks being separate from these talks regarding the nuclear issue, but the highest level talks since 1993, progress being made there. The president's not going to be rushed into a bad deal. He's going to make a good deal for the American people, and he's indicated we're seeing some movement here from the Iranian side.
The president yesterday talked about a ceasefire. We talked about this a little bit earlier, saying that that basically means shooting in a more moderate manner. That's what the ceasefire is. What would it take for this administration to say the ceasefire is off?
Well, look, I think what we're seeing here regarding this is defensive actions. Of course, we saw Operation Epic Fury, decimation of their defense industrial complex, their missile complex, their Navy, for example. But of course, we're going to take defensive action to protect U.S. interests and U.S. troops. That's a common sense approach. We also have in this context economic fury, that are a blockade that we have Iranian ships, Iranian ports. So there's leverage the president has. He has all the cards here. And what we saw the secretary describe before Congress is we are seeing the Iranian regime talk about many of the things that they refuse to talk about for months. But the president also being clear he's going to see this objective be fulfilled one way or another. The Iranian regime cannot have a nuclear weapon.
The Wall Street Journal reporting overnight that Trump told his aides that he won't resume an all-out war with Iran unless U.S. troops are killed. Is that going to be the line where potentially we could see more offensive attacks?
Well, look, as the president's saying again, we're going to take defensive action to protect U.S. troops, U.S. soldiers. I'm not here to predict the future about what the president may decide, but of course we're going to take that defensive action. Of course we are. That's a common sense approach. If we see threats against U.S. interests, U.S. troops, we're going to be acting, and the president, the DOW, has done just that.
Why isn't the International Atomic Energy Agency involved in these talks?
Well, I mean, we see the president talking about a role for the IAEA in terms of the destruction of the nuclear dust. The president, this has been a long-standing concern for the entire world, the threat that the Iranian regime having a nuclear weapon could have. It's the president who has taken action to actually address this.
Well, the IAEA came out overnight with a report where they said that the risk of Iran developing a nuclear weapon right now is higher than it was a number of months ago, raising concerns that they don't have access to oversight and saying that they would like to be more involved in these negotiations. Do you have any understanding of where they are in this and the urgency to get them in to be able to surveil what's going on?
Well, again, part of the discussions we're having here, as the president has indicated publicly, is regarding the destruction of the enriched uranium. Uranium that was enriched beyond a point of any sort of peaceful purpose. The IAEA, the president indicating, would play a role within that. Regarding where the Iranian regime is, as the secretary discussed before Congress, they were attempting to develop a conventional weapons shield, which they could act with basically impunity to develop a nuclear weapon. The president taking clear, concrete action to decimate that conventional military shield. So the president taking action to prevent the Iranian regime from having a nuclear weapon consistently from the beginning of this administration.
How effective has the blockade been? We've had this blinking contest for a while, trying to work out at what point will we breach storage capacity in Iran. Have you got anything to share with us this morning about how effective that blockade has been?
Well, it's been incredibly effective in terms of blocking revenue from going to the Iranian regime. Hundreds of millions of dollars a day being blocked from the Iranian regime. This is also the broader context of that maximum pressure policy. We're actually continuing to take action at the State Department and Treasury Department to target entities that are trying to evade U.S. sanctions that are designed to deny the regime the funds they need for their malign activities. We saw actions as recently, either yesterday or earlier this week. Those actions have continuing. So this economic fury is continuing. We're seeing, in terms of the effect, hundreds of millions of dollars being denied to the Iranian regime.
Secretary Rubio was in front of the Senate Foreign Relations Committee as well this week, and he said that Iran has laid very large parts of the Strait of Hormuz with mines. Have any of them been cleared? How much of the strait is still mined?
Well, the president indicating that we're taking operations to see that demining of the strait. I think this also shows the difference here. The Iranian regime trying to close the Strait of Hormuz and say that we should be able to control who goes to the Strait of Hormuz. That's why we saw this blockade of Iranian ships and Iranian ports. We're not going to be in a situation where we're going to accept a country deciding unilaterally who gets to use an international waterway. That's not going to happen. The president and the secretary both indicating that.
Tommy, can you see why people on Wall Street right now are slightly frustrated with some of the communication coming from the White House? And I'll give an example. The president said the strait would reopen back on April 17th. The strait did not reopen. It feels like we're getting the same headlines recycled every week. Can you see the frustration right now for people on Wall Street tracking this story?
Well, look, I think fundamentally the president's a deal maker. We saw the action. He takes the action he needs to take. We saw it with Operation Midnight Hammer. We saw it with
Except
Operation
he's not
Epic
making
Fury.
a deal, is he?
Well, I think he's working on that deal. I mean, we're seeing him make more progress than anyone's ever made in terms of this addressing this issue, in terms of the real results we've seen from these operations. The president wants that diplomatic approach. But fundamentally, the Iranian regime cannot have a nuclear weapon. That would have been an untenable threat to the region, the entire world. That was being addressed, that has been addressed, that is being addressed.
Tommy, appreciate your time.
All right,
thank you, sir. Thank you very much. The State Department spokesperson there, Tommy Pigott, on the elusive Iranian deal. Let's hope we make some progress and pretty soon, because, as I say, on Wall Street, the frustration with this story, sky high.
Well, I think the issue is, and anyone who's covered Iran knows this really well, it took 20 months to do the JCPOA. Whether you agree with it or not, the Iranians drag their feet, and they have a very high threshold for pain. They don't care as much about their domestic politics the way a U.S. president has to care.
Crude this morning down about 1%. Brent crude around 96. Coming up next, we'll catch up with Angelo Zino of CFRA as Broadcom's outlook fails to impress. That stock this morning getting hammered in the pre-market. Here's a picture of the stock market this morning, pulling back on the S&P 500, pulling back on the Nasdaq, led by tech. We'll get to Broadcom and CrowdStrike in just a moment. On the Nasdaq 100, we're down by 1.2%. Yesterday on the S&P, snapping a 9-day winning run, falling short of the longest winning streak since the 1980s. 90s following a 20% move off the low on the S&P 500, just taking some heat out of this equity market. Turn to the bond market board. Check it out. 2-year yields, 10-year yields, 30-year yields coming down just a touch. We're down 3 basis points on a 2-year at 4.05%. The data so far this week, the details are nuanced, I get that, but on a headline basis, the data so far this week, claims, the ISM, job openings, take your pick. We'll get claims later. But the data so far this week has been pretty decent.
Yeah, ISM manufacturing outperformed. JOLTS came in stronger than expected. ISM services came in hotter than expected, although the caveat there being the employment figure. So again, trying to understand the employment backdrop to really support the extreme economic beats that we keep getting from the U.S.
The bond market just not in the driving seat at the moment at all. It seems to be about the economic data, which is okay, and the earnings. Are there some cracks in the earnings? Let's talk about some single names. Your morning movers, Yahira has more. Hey, Yahira.
Hi, John. The AI trade is under pressure this morning, and Broadcom is at the center of it. Shares are falling 13% after it gave an AI chips outlook that failed to clear an increasingly high bar. As you said earlier, the stock had added some $270 billion in market cap in just the past 5 sessions, leaving little room for disappointment. And just to give you a flavor of what the analyst community is thinking, Citi says any pullback should be viewed as a buying opportunity. Another company that failed to impress investors is CrowdStrike. Shares also plunging some 10% in the pre-market after the cybersecurity company delivered an outlook that largely matched expectations but failed to justify a nearly 60% surge in the stock year to date. Investors have been betting that AI-powered cyber threats would create a wave of demand for its products, but the outlook failing to reinforce that thesis. And we end on the consumer with Five Below. Shares also plunging 10% in the pre-market, even after it delivered a beat and a raise. And the issue here was the warning that Five Below gave on the consumer, saying that higher tax refunds helped drive spending this quarter, but that things will take a turn in the second half with the consumer feeling the squeeze from higher inflation. John?
Yahira, thank you. Bit of a lesson yesterday afternoon following those earnings, the difference between analyst expectations and market expectations, and sometimes there's a bit of a spread. I think we learned that with CrowdStrike.
Yeah, essentially, the analyst expectations aren't good enough, and the market is expecting much more than that. They've been spoiled, and truth be told, because you've seen beats that are some $10 billion by some companies in revenues. So you start seeing that kind of outperformance in some of these companies, you start thinking this is normal.
When a beat and raise is not good enough over at CrowdStrike. On our radar this morning, the US saying the ceasefire with Iran is holding up. The president confirming Israel and Lebanon have agreed to hold strikes, addressing a key sticking point for Tehran.
We actually spoke with Hezbollah for the first time ever. We didn't know they spoke. And they agreed yesterday they're not going to shoot. Israel's not going to shoot. We're just going to see.
The president on Hezbollah. I mean, sometimes you don't know what to say. How do you respond to that?
We didn't know
they spoke.
We didn't know that we spoke, yes.
They're part of the Lebanese government.
Yes. That was interesting.
Yeah. Hezbollah yet to agree to the deal, reportedly firing rockets at Israeli troops in the last hour. Elsewhere, the Bank of Japan considering hiking rates when it meets later this month. Sources telling us here at Bloomberg officials are likely to raise the policy rate to 1%. They see scope for more hikes, citing persistent upside risk to inflation. And finally, JP Morgan boss Jamie Dimon pitching the SpaceX IPO to the bank's high net worth clients today. According to invites seen by Bloomberg, Dimon hosting the interactive discussion with SpaceX executives. It will be cast to 90 JP Morgan locations in 26 states.
Yeah, with thousands of some of their high net worth individuals joining in. A question here about JP Morgan's involvement. First of all, not the lead bank at all. That is Goldman. That is some of the other banks as well that have gotten that lead left kind of position. The fact that Jamie Dimon himself is pitching this is notable, and the fact that it's coming with a price tag that's already fixed is notable, and it comes with a much bigger potential participation from the retail investor just based on the share going to them, and frankly, the scope of paper that needs to get taken down by people who might not already have exposure.
Well, it's really interesting because you look at the arc of this relationship. This is when Elon Musk at Tesla, Jamie Dimon, JP Morgan, there have been lawsuits. They've had a lot of issues, but I was reminded yesterday reading this story that Jamie Dimon said something at Davos a few years ago. They hugged it out, and that he is the Einstein of our generation. So I'm not surprised that he's taking this personal touch, because who knows, there might be another one for Elon Musk, another public offering, and he can, get the number one bank.
I'm going to park JP Morgan and Jamie Dimon and just talk in general terms, of course. Money can convert a lot of people, and there's so much money to be made from this IPO. This isn't your usual IPO. This is a company that's been in private markets for 2 decades, founded some 24 years ago, coming to market raising $75 billion, which is a multiple of the largest IPO we've ever seen. In fact, the demand is so high, and we covered this story earlier on this week, that SpaceX and Elon Musk is basically telling the bankers now what the fees will be. And before the roadshow, he's fixing the price. That just tells you how much leverage right now that company has, or at least the leverage it believes it has, coming into this process.
And the incentive from the biggest bankers of the world to pitch this very hard,
big time,
to get this cleared in a positive way, especially given the fact that this is the lead up, the appetizer to 2 other very big IPOs. All of these banks want a big piece of that too, and they want to get the fees associated with all the add-on deals. You take a picture of that and you understand why there's such a bullish tone coming out.
All these C-suites are incentivized to keep everything spinning, to keep everybody dancing, to keep this market at decent levels. No one wants to push back and ruin the party. There's so much money to be made. And if you're not on the inside, you're behaving very differently. Jefferies in the story we wrote in the last 24 hours offering a vehicle to take the other side of the trade because they're not part of the IPO process. At least that's the way people believe things have played out here. That tells you everything you need to know.
Yeah, well, it tells you 2 things. Number one, there are some people who are getting skeptical about the story and the euphoria around some of these names. And number 2, if you're not in on it, you are bitter and you are going to come up with a way to play the other side.
Let's talk about Broadcom and the other side of the trade, lower in the pre-market this morning. AI chip revenue falling short of Wall Street estimates. Angelo Zino of CFRA maintaining a buy rating on the shares and writing the following. The bar was extremely high. Broadcom delivered exceptional results. Angelo joined us now for more. Angelo, welcome to the programme. The numbers are exceptional, your words. The reaction is not. What's the lesson from the reaction this morning?
Yeah, I mean, and I think that summed it all pretty well in the sense that, you know, expectations were definitely high kind of going into this, right? And I don't know, you know, as far as lessons learned here or you know, what we can make out of this, you know, I would say, listen, the demand environment looks extremely good still. Valuations actually still look pretty good, especially on Broadcom's side of things. And this is not, you know, something where expectations have really been built up too high. But I'd say this is one of those situations right now where when we look ahead, there are still red flags to consider here. Broadcom kind of, I think, brought up some of those concerns that the market may have looking out into 2027 and beyond. So, you know, you kind of have to start putting all that stuff into context. But you kind of look here for Broadcom, you know, over the next, you know, a couple of quarters, and Broadcom more specifically than others, they remain very entrenched in the key players out there within the AI ecosystem. And as a result, you know, I think this is a place you still want to be, acknowledging, though, that there are risks that are heightening.
Angelo, as a group, these stocks have absolutely ripped. But within the group of chip makers, there are individual different strategies. Broadcom notably helping others build chips for themselves. Slightly different to the strategy at some other chip makers. Angelo, how is that strategy playing out at the moment?
I mean, I think for Broadcom, they've got some pretty good visibility because of that strategy. And, you know, you kind of look at, again, who they've kind of built and partnered with here over the last couple of quarters. That visibility is there. But you kind of, again, you kind of look at, you know, where the money is flowing right now. It's not going to the NVIDIAs and Broadcoms of the world, which have really been the 2 big winners and taken the lion's share of the AI you know, money here over the last couple of years. It's going to you know, the content gainers or perceived content gainers that we expect to see here over the next couple of years. It's those bottleneck guys. It's the CPU players. It's the optics guys. Some of those guys that maybe haven't benefited as much here over the last couple of years that are going to maybe sell into the NVIDIAs and, you know, other guys of the world. So those are the winners at this point in time. Again, if you're kind of more of a long-term strategic player looking at valuations and growth, you know, as well, I think kind of the more balanced approach at this point in time probably shifts a little bit more towards Broadcom with this pullback as well as NVIDIA.
There's an important potential theme that could be emerging, Angelo, and I'd love your thought on this. Are we already seeing the CapEx plans by the hyperscalers getting fully priced in the semiconductor index? And essentially, if you want that kind of growth, that trade at least is over, and it's got to move elsewhere.
I think that's a fair point to make. We obviously don't know until all this stuff kind of plays itself out. But I think you're right. I mean, I think as far as the CapEx expectations are concerned, as we look out here into 2027, the expectation is you're going to get another record CapEx spend year, and then we'll see what happens in 28 and 2029. But yeah, I mean, as far as the CapEx numbers itself, probably. That is largely priced in, with also the caveat that there could potentially be risk to those numbers as we go into 27 and 28, not because of what's going on from a demand perspective, but more so on maybe, let's call it, some of the energy bottlenecks out there. When you look at a company like Broadcom that reported last night, they did hint at, or they cited that the rising backlog out there, but that rising backlog is increasingly being dictated to more, forward kind of numbers, and the big reason for that is a lot of these players out there need to ensure that they're getting access to that power. So you could potentially see some hiccups along the way as we kind of again get into 27 and 28 tied to some of those CapEx expectations.
We're seeing right now the pullback after the SOX index is up almost 100% so far this year. I mean, it's been a pretty stunning rally. Oh. From your perspective, what would you have to see to say, yeah, we've seen the top. Yeah, we probably have seen the bulk of the gains?
Yeah, I mean, that's a great question. And I don't know if that's one that can necessarily be answered. I think this is one of those situations where you never know where valuations are going to go when it comes to the chip industry and tech for that matter. I think you can make a case where, as growth rates start to ease going into the next couple of years, those valuations have to kind of compress a bit. And I would think that should be kind of the overarching sentiment. But at this point in time, you just don't know how sustainable some of this stuff is going into the next couple of years. I don't know if there's necessarily some sort of, what that red flag is going to be, because there are so many different ways that this can play out here over the next couple of years. But again, as long as that demand landscape remains intact, and right now it really does, and you kind of look out here over the next couple of years and you look at what the drivers of demand, at this point is, and I think at this point in time you have to kind of assume, again, that in demand looks fairly well. I do think those other bottlenecks, some of those constraints out there, specifically on the energy side of things, is something that could kind of put a dent in the party here, looking out over the next couple of years. But that being said, I think as long as that demand landscape remains intact, the market it's just something the market's going to have to work with. And potentially it does lead to an intermediate term peak. But again, as long as that demand landscape is there, it's something the market could probably work through.
Angelo, good to see you. As always, buddy. Angelo Zino there of CFRA. The beats have been so big that the misses are making headlines. A notable miss from Broadcom this morning. The Nasdaq is down by 1.2%. With an update on stories worldwide, let's get to your Bloomberg brief. Isabel Lee has more. Hey, Isabel.
Hi, John. The House approved a war powers resolution that would end U.S. military action against Iran in a rebuke of President Trump. 4 Republicans joined Democrats in a push to end the 3-month-long conflict. The measure now faces a vote in the Senate. President Donald Trump will attend the G7 Leaders Summit in France later this month. Trump will also attend the NATO summit in Turkey next month, according to Secretary of State Marco Rubio. There were questions about Trump's attendance as he repeatedly expressed anger with NATO members for not helping with the Iran war. And Anthropic gearing up for its IPO. Sources telling us here at Bloomberg, the maker of the Claude chatbot picked Morgan Stanley and Goldman Sachs to lead its offering. Anthropic was valued at $965 billion after its last funding round, making it one of the largest private companies. That's your Bloomberg brief. John?
Isabel, thank you. Appreciate it. More from Isabel in the next hour. Up next on the program, balancing the dual mandate.
I'm increasingly concerned that higher interest rates could be necessary later this year to fully restore price stability and appropriately balance both sides of the Fed's dual mandate.
We got another one. Andrew Sheets of Morgan Stanley joins us next. snapped the winning streak in yesterday's session. Here's the pullback this morning, down by 0.5% on the S&P, on the Nasdaq down by 1.2%. Broadcom getting hammered, CrowdStrike getting hammered. Not your typical day in big tech. By typical, I mean usually these names are just ripping post-earnings, but we haven't seen that this time around. In the bond market, heading into economic data, and the data so far this week has been decent. Yields are lower by 3 basis points, 4.05% on 2s, but still around 450 on 10s, 447. And more Fed officials just coming around to the idea that maybe it's time to think about tighter policy, not now, but in the future. Under surveillance this morning, balancing the dual mandate.
The labor market appears stable and broadly balanced. These conditions indicate to me that monetary policy is not restraining the economy. I'm increasingly concerned that higher interest rates could be necessary later this year to fully restore price stability and appropriately balance both sides of the Fed's dual mandate.
So here's the latest this morning. The Federal Reserve's Beige Book showing steady employment and rising inflationary pressures. Andrew Sheets of Morgan Stanley writing, "We think the Fed stays on hold, then cuts next year." Andrew joins us now for more. Andrew, welcome to the program. So how would you describe some of the commentary we've had from certain Fed officials? Is that just theatrical, a communication exercise, or is it something else?
No, thanks, and good morning. Look, I think it's accurately describing the state of play to this point. You know, the Fed's dual mandate is inflation and jobs. On jobs, the labor market remains very solid. Unemployment's, 4.3%. But on inflation, the 3-month, 6-month, or 12-month average of core PCE is over 3%, well over the Fed's target. So certainly, I think coming into the second half of the year, there's I think a justifiable concern that the Fed is succeeding on the job side of the mandate, but not succeeding on the inflation side. Now, what we think changes is that we think that inflation picture does look better in the second half of the year. We think inflation does come down, and we think even the next CPI reading that the market will get will be a bit lower than consensus. And we also think the labor market data were a little bit below consensus on this Friday's number. And we think the labor market will remain choppy and again, with enough uncertainty to keep the Fed on hold this year, and then opening up the potential, in our case, the base case, for some cuts next year.
So on net, putting that together, cutting for the right reasons next year, what about the hiking conversation now? Is that conversation for the right reasons or the wrong reasons?
I think it's for the right reasons. Again, the inflation numbers are above the Fed's target. They've been above the Fed's target for a number of years, for an extended period of time. And I think there is a lot of uncertainty around where inflationary pressures of the economy really are. We were just talking on this program in the prior section about semiconductors and the enormous demand for AI infrastructure. I mean, there are huge increases in the costs of memory and power and compute that are going on as you have this historic build out within the AI ecosystem. So you look at things like ISM prices paid, either on services that we got yesterday or on manufacturing. Those measures are pretty elevated relative to the last 20, 30 years. So there are certainly, I think, signs that the Fed should be on guard for those higher inflationary pressures. Again, in our view and in our modeling, those pressures do ease in the second half of the year. And so by the first half of 27, that creates some space for the Fed to ease policy modestly. But it's absolutely, I think, a very fair thing for these officials to be thinking about and contemplating.
Do you think that there is anything that could happen between now and the end of this year that you think should prompt them to raise rates?
So I think there'd be a few things. I mean, and again, I think the elephant in the room would be the Iran conflict. Our thinking is that the Fed would look through that the Fed would see that as more of a growth shock than an inflationary shock. And so that's probably not the factor that we think would move the Fed towards hiking. But I think it would be a few things. One is it would be that you start to see core services continue to remain elevated. And again, right, a lot of disinflationary pressure is coming from the shelter categories, from housing. You could argue those are more backward looking, and it's some of the core services numbers that are representing the real kind of tightness in the economy. I also think this idea that if jobs growth looks a little bit better in the second half of the year, again, the first half of the year, the data was very noisy. And I think there's been a lot of fear around kind of AI related technological progress leading to job losses. if that does not happen in the second half of the year, then again, I think you have a situation where maybe the Fed feels a little bit more comfortable. But I think it really needs to run through the inflation path. I think that's the thing that we think is most likely to move the Fed towards a hike. Again, I think we'd be watching inflation break-evens. Those have still been reasonably well behaved. But I think if those were to move higher as a sign that the market is getting more concerned about this mix of easy fiscal policy, bank loan growth accelerating, kind of more market confidence, and then just broadly a lot of AI spending into the economy, I think we'd expect that to show up in higher inflation break-evens than we see today. Maybe that is something that moves the Fed to take that step.
Andrew, does the Fed matter still? I mean, they're sensibly in this restrictive position, at least according to them at their last meeting. And we're seeing incredible issuance in the corporate debt market. We're seeing IPOs that are the biggest of all time. And we're seeing valuations that are extremely rich. How do you square this?
Yeah, so I think the Fed being on hold is absolutely fine. I mean, I think the way I would answer that is the market does not need rate cuts to be strong. And I think there is a lot of good precedent for the market remaining quite robust and remaining at elevated valuations when the Fed is on hold. We saw that in 2006. We saw that through a lot of the second half of the 1990s. The market doing just fine if Fed policy is stable. In some ways, stable policy suggests that policy is in the right place. I think, though, a hike would matter. I mean, and even if it was only 25 basis points, the markets have a tendency to extrapolate. And so if the Fed or any central bank, whenever you make one cut, the market's naturally going to ask, well, when is the next one? And I think given that the market has been so confident that the next move from the Fed, whenever it is going to be a cut, I think stronger signs of the Fed moving towards a hike absolutely would inject more volatility into the market. And also it would, potentially flatten the curve, which could undermine some of the strong demand we've seen for fixed income and for corporate credit. Again, the fact that yields are higher has been great for bond demand. But when you go back to 2022 and when that curve was flatter or even inverting, those high yields didn't bring in the same demand. Flows were weaker. I think the inverted curve had something to do with that.
Andrew, appreciate it. Bit of a clinic on fixed income. Andrew Sheets there of Morgan Stanley into the back half of this year where there is a conversation beginning to emerge slowly at the Federal Reserve to consider tighter policy.
And the market's essentially saying, please consider this, please look at this, because we're pricing in a rate hike almost entirely by the end of this year, something more than 50%, 70% the last I checked, of a chance of a rate hike. At what point is the market also sending a signal, like we heard from Chris Verone, that yields where they are not high? In fact, they're completely manageable. And this is not necessarily restrictive monetary policy. Lots can change. But where the pendulum swings, I think a lot of people are debating.
I get the sense that's the argument that Laurie Logan is making at the moment as well. Not much evidence for sufficiently tight, restrictive monetary policy right now.
When you see the incredible issuance, when you see the IPOs, when you see the risk appetite, it's just not there.
Up next on the programme, don't miss this, Jim Zelter of Apollo Global Management. Then we'll catch up with Betsy Stevenson of the University of Michigan, plus the former White House senior advisor, Amos Hochstein. The second hour of Bloomberg Surveillance just around the corner.
Whatever concern we have about the consumer, they're still spending.
The Fed will remain on hold for the rest of the year.
No matter what the Fed does, everything else is kind of self-correcting.
You're seeing a bond market that flipped from cuts to the potential for hikes.
The bond market still very much believes that the Fed is going to fight this inflation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Pulling back yesterday, again this morning, just a little bit. On the S&P 500, we are down by 0.5%. On the Nasdaq, by more, by 1.25. Here's the stock responsible for much of the move so far in the pre-market, Broadcom. Disappointing. The stock is down by 14%. The analysts look at the numbers and they say the numbers are still exceptional, but the numbers fell short of some very high expectations.
Yeah, essentially, Broadcom beat, although the sales missed some expectations that were incredibly lofty. You did see this actual guide up for the current quarter in terms of revenues and profits, but not as much as some people had expected. The response tells you more about positioning and more about what we've been seeing in other earnings, which has been earnings needs to keep performing outperforming in an incredible way for people to have faith in a story at these valuations.
I'm really honing in on the supply and demand issue today. TSMC saying they're not going to be able to fulfill demand led by these American customers. On top of that, you had industry groups. I'm talking about medical devices, the Retail Federation, writing letters to the Treasury Secretary, the Commerce Secretary saying, we're excited about this AI build out, but we also need access to memory chips. And this is going to be a huge problem for us, our industries, and the American consumer.
Bit of a pullback in the equity market. More still to come on that topic. Let's turn to the day ahead. Jobless claims a little bit later this morning at 8:30 Eastern Time. We've had a string of decent data so far this week. Job openings, ADP, ISM manufacturing. So far, so good. I've said that a few times through the week.
Yeah, although a lot of questions about what's under the hood of that. There was some data that came out this morning from Challenger Gray and Christmas, the potential planned job cuts. And in general, they're actually going down. Okay, positive for the market. But you're seeing the tech sector planning the greatest number of layoffs, cuts, in about 2 years. And they tie it directly to the deployment of AI. And this kind of goes to the anxiety a lot of people are looking at. Is the job growth or even some of the resumption of strength sustainable, not only broad-based across the job market, but in some of the higher paid jobs that can lead to wage growth and a persistence of some of this consumer strength?
Look at the estimate for tomorrow morning on payrolls, 85K. It's pretty decent. We're told the break-even rate might be somewhere closer to zero. You get an 85K. There's evidence that job growth is still pretty healthy in this economy.
The unemployment rate's going to be key. The hours worked is going to be key. These are the metrics people will look at to understand whether this Fed does have a dual mandate, and one side of that mandate is just fine, and the other one not so much.
Futures this morning, negative 0.5%. Coming up this hour, we'll catch up with Jim Zelter of Apollo Global Management on big tech's mega spending spree. We'll speak to Betsy Stevenson of the University of Michigan on the AI-driven changes impacting the workforce, and the former White House senior advisor Amos Hochstein on the struggle to make progress with Iran. We begin this hour with Broadcom pouring some cold water on a red-hot tech rally. Apollo Global Management President Jim Zelter is highlighting a pressure point on the horizon. He writes the following: if Alphabet can't self-fund AI CapEx, think about the smaller players. June is shaping up to be a real stress test for the investment-grade market. Jim joins us now for more. Jim, good morning. Good to see you.
Good morning. Always fun to be here.
Think about the paper that we've been moving. We have priced almost $1 trillion plus of investment-grade credit in almost record time so far this year. We're talking about mega IPOs on the horizon. Alphabet issuing numbers that are so difficult to internalize, an $85 billion capital raise. Is the demand out there to meet the supply?
I think it just shows the breadth of these global markets, and I think if I've come here in the last couple of years and I've used a term, it's always and, not or. It's the IG market and the private credit market and the equity market, and I think that theme just really continues. I mean, certainly what Alphabet executed this past week, in the scale, the scope, I suspect it won't be the first big mandatory convert that gets done. I'm sure many other companies in that sector are now looking at these securities, the ability for an investor to clip a nice coupon and have a debt exposure to these companies. I think that's a new market. But I think also, I would also ask you to take another step back.
Sure.
It's not only the scale of these. I mean, the last 15, 20 years, the annual equity issuance between IPOs and equity capital markets activity has been plus or minus $200 billion a year. That's the number the last 20 years. You take the year of 21 out with SPACs. With OpenAI, Anthropic, and SpaceX, those three companies will eclipse that number. And I think there's commentary about what it means to take a company public today. I mean, the scale that you need to achieve to be relevant is much, much higher than it ever was before. That impacts a lot of smaller enterprises that are 5 to 10 billion. I also think, as much as we're talking in the last 4 to 6 weeks about the AI CapEx boom, which is phenomenal and unprecedented, I think we're forgetting that there's a lot of other industries. There's the defense industry, there's the utility industry, there's going to be a number of other industries. So I think it's broader, but these numbers are unprecedented, but it just shows you the scale of the marketplace.
You're getting to the heart of a potential issue, though. Is there space for everyone? How much crowding gap will there be?
Well, I do think, we've been consistent, Torsten's been consistent about the impact on longer tenor rates for governments around the globe. I think that is a very real issue. I've been consistent coming here in January and February and April, that rates were not going down in the short term. I do think, we've always talked about 15, 20 years ago, the crowding out effect of government debt. I think you're seeing a potentially long-term crowding out of this massive, long-duration CapEx boom around the globe and the impact on government debt yields around the globe. So I think there is some dynamics to that. But as I said a few weeks ago, this year the IG market will have net issuance higher than the Treasury market in the U.S. I mean, we got to put these numbers in perspective. The Mag 7 CapEx this year will be larger than the Defense Department spending. I mean, these are phenomenal numbers, and again, I just think it's broader. I think there is no doubt that there is health and breadth in the market, but I think some pullbacks once in a while and some good questions that get answered. These numbers are unprecedented, and these companies will have to make the return on capital to justify the CapEx.
How are you at Apollo trying to protect yourself against the increasing risk as these numbers get bigger and bigger and as expectations get higher?
Well, it all goes down to what your liability is. For us, because we have our third-party business as well as our regulated balance sheet, we're trying to find areas where we can fund the picks and shovels, the AI infrastructure, not just the AI CapEx to the equity. There's a difference. We've been rumored to be involved in a variety of chip financings, and those financings allow you to get in the middle of a variety of investment-grade companies that want to fund the purchase of the chips for a variety of these companies, and you can do it in a structure that basically lets you amortize that risk over 3, 5, 7 years. So you either are or taking, if you take residual risk, you've taken your basis down to zero. So I think there's ways to do that. I'm not suggesting there's investors who are really good at buying the equity of these businesses.
Sure.
That's not what we do. But I think the ability to fund the infrastructure and really structure it such you're not taking residual risk, I think there's an ability to do that. Now, it comes at a lower rate, a higher quality counterparty, but that's all really structuring.
Well, let's talk about the rumors. So I'll explore them in ways that maybe don't put you on the spot too much. Let's just say there is a firm that's getting together with another firm, maybe talking about roughly $36 billion of debt financing to help maybe some company like Anthropic pay for some chips from, say, Google that Broadcom helps develop. Let's just throw that out there and just say maybe that's a story that might be on the rise and something that happens. Let's get into how you structure that. So there's a senior tranche, and then you've got a subordinated tranche as well. Can you just explain to us how you could use an IG balance sheet like Broadcom to support something like that? Just help people understand how you put this deal together.
I think that what I would want to highlight is in every financing, there's folks who want to take shorter duration risk, 1, 2, 3 years. There's folks that want to take longer duration risk, 3, 5, 7 years. There's either senior and then there's subordinated. So between maturity, between where you fit in that stack, you appeal to different buyers in the fixed income universe. The fixed income universe is like the equity universe. There's value buyers, there's growth buyers, there's growth at a reasonable price buyers in the equity market. In the fixed income market, there's folks who like short duration risk, 1 year, 2 year risk, i.e. sometimes banks. There's longer duration investors who will take more of a residual risk. And so you're just appealing to different risk tolerance, all in the investment grade community, but you're doing it just like in the equity market when Alphabet goes out and raises an equity deal and a mandatory convert, you get what they're really doing is they're appealing to an income buyer in the equity market that might not necessarily be able to buy that equity because of the low dividend yield. So again, you're just really appealing to the beauty of the U.S. is we have the most robust, deepest, broadest markets in the world. And so, a company can do a mandatory convert 5, 10, 15, 20 billion in size, and there's plenty of equity income accounts that want to buy that. And you can also do a large equity offering and then a follow-on at-the-money offering over the next several months. And there's breadth and depth. Really nowhere else in the globe has that breadth and depth of the marketplace.
Breadth and depth is certainly here, which is the reason why you're seeing these incredible IPOs and debt issuance. The scale of money being raised, though, around the world really is mind-boggling. It's not just the U.S., it's Germany. It's also over in Asia, in a number of places, whether it's IPOs, whether it's corporate debt. where is the money coming from, right? I mean, how do you compete for this money? And how much higher do yields have to go, not just in the Treasury world, but also on your end when you see coupons? Don't they have to climb considerably just to compete for your capital?
Well, relatively, even though rates have risen to where they were 3 to 4 years ago in the U.S., rates in the U.S. are approximately where they've been over the last 30 to 40 years. Like, we're in a more normal rate environment right now. And a theme that I've been talking about when I've been here over the last couple of years is we have an amazing, broad retirement challenge around the globe. There are many investors in the UK and Canada and Australia and the West that do not have the right retirement savings structure. At the same time, you've got this major global industrial CapEx. Today it's in AI, it'll be in other industries, and appropriately matching that duration of demand for assets with the duration of the companies needing to borrow money, you'd be surprised the depth and breadth of these markets. And so, we're active now in the UK. In the UK, there's a concept called matching adjustment, where as a regulated balance sheet, you need to actually have long duration. And so they funded student housing and a lot of other activities. So, I do think there is a natural point in time right now where we do have these retirement pools around the globe that are looking to invest long term. And actually, if you look at what the Treasury market has done, the Treasury's really been funding a lot of their financing in the short end the last 3 to 5 years, really 1 to 5 year financing. There's a shortage of long duration paper out in the globe right now. You've had other guests on this show talk about the lack of long duration assets against the breadth of long duration liabilities. So I do think that's a broader theme that we should talk about. The other thing I would talk about is, this came up last year. We were talking about a lot of the tariff activity. The benefit of the breadth of these capital markets is U.S. companies are the beneficiary of lower cost capital and access to capital. That's a flywheel of economic growth. And again, going back what Alphabet was able to do, their IPO was, $1.7 billion 26 years ago or 25 years ago, and it is phenomenal. But it's a hidden gem of the U.S. economy. And so when we talk about taxing foreign investors, we have to be very, very careful, because this cost of capital, this breadth of capital, I think it's no surprise that we've been leading the globe in this CapEx cycle, because these companies do have access.
It's the secret sauce, without a doubt.
No doubt.
Without a doubt. Are we at the creative stage of financing? From the outside looking in, people might hear some of these stories, the conversation we just had, and they'll think circular financing, off-balance sheet debt. Are we at the creative stage? The more dangerous stage, I would suggest.
I think that you always have to be aware of who's taking equity risk at a fixed rate of return. I think, my 41 years tell me I want to be investing with the leading companies. When you think about the world today in terms of winner take most, concentration in the top 3 or 4 companies, I think it would lead you to be wanting to invest alongside these companies, and to do so in a manner where you are well structured with downside protection. But I think that let me be very clear. There will be companies that enter this CapEx cycle, some on the investment grade side, some on the non-investment grade side, that their business models will prove not to be as resilient over 5-10 years. That's the destructive aspect of capitalism. And I think you're getting paid for it still with a lot of structure. But I do think the overall trend is in the right direction.
So we're not at the very precipice of hitting capital constraints right now?
I don't think so. I think, I do think it's interesting. When you think about, why Alphabet did this, I mean, there is a depth and breadth in the IG market. We talked about it earlier, how much they've done. What's interesting, though, is I talk about a lot is, in the equity market, if you're an investor, you don't mind, or you can absorb the idea of getting very concentrated in a name, because you can move in and out of it very quickly, and you're getting paid because of the convexity of that equity. In the fixed income market, as a IG buyer, bonds don't go to 200. They can go down dramatically. And being a little facetious there, but my point is, you need to have breadth of distribution and diversification in the fixed income markets. And so it's not as if Alphabet or Microsoft or Broadcom doesn't have exposure. They're just trying to find a broader universe of other buyers that will be able to access and provide funding.
Jim, you're going to stick with us. Jim Zelter there of Apollo Global Management. Equity futures this morning down by about 0.5% on the S&P. With an update on stories worldwide with your Bloomberg brief, Isabel Lee has more. Hey, Isabel.
Hi, John. Bank of Japan officials are considering a 0.25 percentage point increase to their interest rates. Sources telling us here at Bloomberg, the central bank plans to leave the door open to another hike later this year. The BOJ is set to meet on June 16. Partners Group is ready to curb investor redemptions in more of its private equity funds. This comes after redemption requests from its private wealth clients surged to more than 9%. The announcement prompted a sharp sell-off in the Swiss firm stock. And more than 24 hours after the polls closed, they're still counting votes in the California governor's race. With 58% of precincts reporting, Republican Steve Hilton is leading, followed by Democrat Javier Becerra. Fellow Democrat Tom Steyer is holding on in third. That's your Bloomberg brief. John?
Isabel, thank you. More from Isabel later this hour. Up next on the program, uncertainty in Iran.
In that part of the world, ceasefires when you're shooting in a more moderate manner. The negotiation itself has gone very well, actually. It might not happen, who knows? But if it happens, it could happen like over the weekend.
Up next, we'll catch up with Jim Zelter of Apollo Global Management on the threats abroad from New York City this morning. Good morning. Equity futures on the S&P pulling back just a touch. We're down by 0.4% on the S&P. On the Nasdaq, we're down by 1.2%. Just a little bit softer in the equity market. Under surveillance this morning, uncertainty in Iran.
Is the ceasefire with Iran still on?
Well, there's a reason for everything. And we hit them pretty hard. In that part of the world, ceasefires when you're shooting in a more moderate manner. The negotiation itself has gone very well, actually. It might not happen, who knows? But if it happens, it could happen like over the weekend.
So here's the latest this morning. The president maintaining a deal could be near as Tehran says there has been no tangible progress, and Hezbollah and Israel continue to exchange strikes.
They continue to exchange strikes. And a question we have been asking on this program is at what point would this administration say, actually, drones coming at our allies, ballistic missiles coming at our allies and our air bases means that the ceasefire is over. I think the most important story is the Wall Street Journal overnight saying Trump has told aides privately that when he would consider ending the ceasefire is if Iran targets American troops directly. So if American troops' lives are injured in a way or that they're killed, that is when maybe he would decide to end the ceasefire. So basically, I think this tells Iran they can continue with some of these clashes and skirmishes until they get a deal. The president says we're going to get a deal soon, but the point you've been making continuously is how many times have we been here since the end of February?
For markets, it hasn't really mattered. Who remembers this conversation from a few months back? Take a listen to this.
Sometimes there's days we should just go out and just take a walk around for 30 minutes. You just had a quarter with record M&A, literally record M&A in the United States and globally. We've really lost the plot on credit. We're talking about a little bit of skirmish on the sidelines here. I suspect if I'm sitting here in 3 to 6 months, we'll be talking about a much, much different backdrop.
Here we are a few months later. Jim Zelter back with us. Jim, congratulations, because you were dead on. Absolutely right. A few months later, the market stopped having this conversation about this issue.
Well, it was interesting to see with a strong earnings season in the last 6 weeks, and they were strong across the board. The big focus was CapEx. Who has the bigger CapEx budget? And listen, that's a marketplace where there's more greed driving the market than fear, as David Solomon quoted yesterday. So that's certainly the backdrop. I mean, certainly I've been consistent having a view that for the next year to 2 years, we think that inflation is a bit more of a concern. I don't think it's going to affect the fundamentals of the market. I am candidly surprised, and I've been consistent, that if we were still talking about Iran at this point with the straits being closed and the impact on oil prices, that we would see some second and third derivative volatility So I'm a bit surprised, but momentum and emotions can work both ways and they can change pretty quickly. But I do believe this bigger trend is upon us, and I think this will be the conversation we have for the next couple of years.
Take a walk. That was the advice at the time. And it was good advice, too, based on how things have turned out. The one thing that really surprised us is how much earnings expectations have climbed through this war. That was the surprise, clearly to the market as well, Bramo, given the price action we've seen.
Yeah, and when they don't outperform in a significant way, then they're penalized. At what cost? And ultimately, this is one thing I'm wondering whether this is keeping either Jim up or others, the labor market. And at what point do we start to see the ramifications of all of these cuts potentially to pay for AI? And we're seeing that in some of the Christmas Challenger reports earlier this morning.
Jim, what stage are we at? The return on investment stage? Is that still further down the line? Are we at this point where you have to cut operational expenses to support a lot of this funding, a lot of this debt, a lot of this money?
I think there's some marginal optimization around hiring right now. I think the secular trends that are the big question mark in front of a lot of folks, if we're sitting here in June of 28, we will have a much better insight in terms of really what's the secular impact of this CapEx cycle and AI on broad employment numbers. I think any changes you see over the next year or two where a quarter of a percent up or down, I don't think they're long-term secular trends. And I think we'll be talking about how does the extent of this CapEx cycle, the extent of the AI boom, the extent of return on invested capital. That's the conversation I think we'll be having. And I think that then at that point in time, once you have a sense of the employment numbers or the employment impact, once you have a sense of the returns, then that's going to feed into, is the inflation going to be curtailed and turning into a deflationary environment? But I think that's 18 to 24 months out. I think anybody that tells you they really have it nailed right now, I would suspect that they really have not been doing this for a long time. Because I think there's a healthy degree of humility you have to have by making those huge macro views.
Does the labor market keep you up at night, this transformation?
I think it does. I think any leader of a business today is thinking about how they want to evolve their business. Last week, I was at a leadership meeting of a bunch of CEOs down in Texas. They were, these were not all tech companies. And the big questions were, how do I fund my aspirations in my industry? That was a conversation that they would not have invited the head of Apollo to be there 24 months ago. Okay, we were front and center in that conversation. And they're also thinking about how they deploy their resources, of which human capital is the biggest element. And they want to execute their plan today, but they also want to make sure they're investing in the future. And I don't think anybody's having a massive, you're seeing sub-headlines of companies that will make 10 or 20%, hiring cuts across the board.
Yeah.
I don't think that's the mainstream.
Jim, it's always good to see you, buddy.
Always good.
Thank you. Jim Zelter there of Apollo Global Management. A good lesson for us all. I took a walk yesterday.
Good.
Beautiful day in New York. And
it was
go
beautiful.
Knicks.
It was beautiful.
You feel better?
Listen to a podcast with Derek Khosrowshahi.
Oh, nice.
Very good. I'll tell you more about it in the commercial break.
And then you took an
which is not helpful for the audience, but anyway. All right, coming up, Betsy Stevenson of the University of Michigan joins us next on the jobs market. The scale of the numbers involved is so difficult to get your head around all of this and to internalize it. A $75 billion IPO. More still to come later this year. We're talking about SpaceX first. An $85 billion equity capital raise. I've mentioned the number of issuance that we've seen, the supply. On the investment grade side, stateside, topping $1 trillion already so far this year. The scale of it is just off the charts, Lisa.
Yeah, it's the re-leveraging of the industrial world. It's the re-leveraging of the corporate sector. It's the re-leveraging of a world trying to build out for a new future. And the tolerance for it has been absolutely incredible. I mean, we've all been asking, when are the capital constraints coming? When do people start pushing back? When do some of the prices start to get adjusted? Right now, the answer is not yet. Let's keep going.
You don't see a lot of pushback. A couple of cracks this morning. We can talk about that. A pullback on the S&P 500. We're down by 0.4. Pull back on the NASDAQ, down by 1.2. A couple of names in the mix we need to talk about. Broadcom being one, CrowdStrike being another. Let's get into some of that with your morning movers. Your single names, Yahira has more. Hey, Yahira.
Hi, John. The losses are mounting for Broadcom. Shares now down nearly 15% in the pre-market as investors focus in on an AI chip revenue outlook that failed to clear an increasingly high bar. That's because this name has added some $270 billion in market value in just the past 5 days, leaving little room for error. And that weakness is dragging down the entire chip trade. So we are seeing names like Intel, SanDisk, and ARM all falling in the pre-market. These are some of the AI stocks that helped drive the 9-day winning streak on the S&P that snapped yesterday, and just goes to show you how high the bar has become after this earnings season delivered massive beats from the Mag 7, plus companies like Dell and HPE. And we end on PVH. This is the company, the owner of Calvin Klein and Tommy Hilfiger. Shares are plunging 22% after the company cut its sales outlook, even after it said it would get $100 million in tariff refunds this year. That's because the issue is that PVH is seeing weakening demand across the EMEA region due to the war in the Middle East. John?
Yahira, thank you. What do you make of that excuse?
I think people aren't buying it, because if that were the case, those shares wouldn't be down as much.
Exactly.
That struggles to...
I just don't think people are really buying Calvin
That's why I
Klein
give so
anymore.
much credit to the Gap CEO to come out and just say, we missed it.
We missed the mark.
We didn't get it right.
Honest.
I'm not going to blame the war.
You're not going to say...
We missed it.
The sheikhs aren't buying underpants.
Right? It just doesn't...
It doesn't add up.
You know, I hate those excuses, the weather, foreign exchange.
So does
Obviously,
the
it
market.
matters to some extent, but like this...
I'm not trying
You're
to be
either
real.
in the right spot right now in retail or you're not. And it gives me greater confidence when I hear a CEO like the Gap CEO come out and say we weren't at the right spot at the right time. We need to pivot. We need to make a change.
It seems like the shares and the shareholders seem to be agreeing with you this morning.
Equity futures on the S&P 500 this morning down by 0.4%. On our radar this morning, the US and Iran struggling to finalize the details of a peace deal. Israel and Lebanon reportedly agreeing to hold strikes, addressing a key sticking point for Tehran.
We actually spoke with Hezbollah for the first time ever. We didn't know they spoke. And they agreed yesterday they're not going to shoot. Israel's not going to shoot. We're just going to see.
Lebanon's president saying a ceasefire between the two could begin within 24 hours. Elsewhere, SpaceX looking to raise $75 billion in its IPO. That would make it the largest of all time and clear a path for more mega listings, including Anthropic, which lined up Morgan Stanley and Goldman to lead its IPO, which could come as soon as October. And finally, the Swiss asset manager Partners Group preparing to cap investor withdrawals across its $9.7 billion evergreen funds. The move coming after a surge in redemption requests from private wealth clients triggered its stock to plunge. That stock has had a difficult time of it.
Yeah, and this kind of feeds on what people were worried about a couple of months ago, although just as we were talking about with Jim Zelter, it seems like those fears are getting kind of backed out in terms of some sort of broad market ramification. I do think one point that Jim was talking about was really important, which is what he said was the dearth of long-duration bonds or long-duration assets and this glut of retirement funds that needs to be deployed and actually have a matching kinds of assets and liabilities. And I wonder if you start to see a pushback on some of the retail funds that are directed that don't have that mismatch, that have a mismatch in terms of duration. If people want to redeem their assets more quickly, do you start to see an increasingly shrinking pool of potential funds for them to go to?
We've seen that in these so-called BDCs, which is like this big compared to everything else that's happening right now. And everything else that is happening right now is getting funded and financed pretty easily based on the headlines that we've seen.
Yeah, the issue, and we've heard this from a lot of private fund managers as well, saying that actually because of the retail involvement, there are some assets at a discount now because of some of the stress that you saw earlier this year. There is a bigger question here. Do these things belong in retail funds that can be redeemed on a daily basis?
Sure.
And if there is a retail fund, should it have longer-term lockups like all the other funds just to prevent forced selling, and then the people who remain in the fund being left with some of the bad stuff at the end?
Some of the financials had a difficult 24 hours, and that story was part of that. Elsewhere, investors bracing for the May payrolls report due out tomorrow. The Dallas Fed President, Laurie Logan, signaling optimism that AI will boost labor demand.
There are a number of data centers that are either in the planning stage or in the construction stage, and that's creating significant demand for labor. We're seeing wage growth in those particular areas.
Joining us now to discuss, Betsy Stevenson of the Ford School of Public Policy at Michigan University. Betsy, welcome back to the programme. It's always good to hear from you. There's a great debate on the future of this labour market, given the technological revolution we're working through right now. Betsy, how are your thoughts evolving on that matter?
Well, I mean, I think what we just heard her say is we're going to see a lot of construction workers as we build data centers, but that's not a solution to the challenges for white-collar workers as AI starts to increase efficiency. I mean, I think what we're seeing right now is a lot of companies that are still doing really well and able to grow. And that's why we're not seeing a lot of layoffs, but we're also not seeing a lot of hiring. And so what they're doing is they're trying to take these gains in terms of increased productivity so that they can increase their output, but they can do it without hiring workers. And that, I think, I think that's the best way for technology to work through the labor market, is to do it in a period of growth so that people don't lose jobs, but the people who have jobs become more productive. The challenge for the U.S. right now is that it is such a low hire, low fire environment that the people who do need to enter the labor market, either they lose a job or they've been out of the labor market and need to re-enter, they're the ones struggling. And that's why we're seeing the rate of long-term unemployed increasing.
Betsy, it's really hard for us to judge at the moment just how tight this labor market actually is. As you reflect on that, we've had this negative supply shock to the labor market. We haven't had the entrants come into the supply pool, so to speak, because of these tighter regulations around immigration and the enforcement of the southern border. Betsy, with that in mind, how do you gauge how loose or tight this labour market actually is right now?
You know, I think it's actually a labour market where we want to look at the particular skills that workers have to think about whether it's loose or tight is going to depend on exactly the market that you're in and the skills that you have. So I think of it as a time of great reshuffling. You might find that you're in actually quite weak labor market given your skills and where you're at. And that might mean that you need to skill up with something different or relocate. So that's part of why I think we see it as both. Wait, it's a weak labor market. No, it's a tight labor market. I think it's because it's both, and it really depends on exactly where you are and what set of skills you have.
Betsy, where are we in what you referred to before as the white-collar recession?
Well, I don't think we're in a white-collar recession, but I do think that we're not really prepared for a lot of white-collar workers to need to make some transitions. Now, there are some good things. One is that white-collar workers have developed a lot of skills around how to learn and develop new skills. So that makes them actually really well positioned to make changes as their company says, hey, I don't need you to do this anymore, but we might need you to do this other set of tasks. Can you learn how to do them? Can you skill up? And I think historically we have seen that many workers are able to do this. And, you know, one of the other things with AI is that it is disproportionately going to impact women's jobs held by women. And women have historically been a bit more flexible around, whoa, I need to change what I'm doing because my old job isn't there anymore. So I have a lot of optimism that we're going to have a lot of ongoing demand for human workers. And we have workers who are able to have the flexibility needed to make changes. But I think we should understand that any period where people are having to make changes, where there's uncertainty, is going to be a period of weaker consumer confidence and anxiety around for the public.
So if you push this through the Fed's response mechanism, a lot of people are looking at the labor market report tomorrow as a guide to whether the labor market can be some sort of indication of weakness that could leave the Fed on hold indefinitely or even remaining with an easing bias. Do you think it's an appropriate stance for the Fed to be a bit more dovish with this type of backdrop? Or do you think that they should prioritize inflation because of the uncertainties around the labor backdrop?
Look, inflation isn't good for workers either. I think, Jerome Powell said that a few press conferences ago, and it really stuck with me because I think it's important to remember that workers don't want unemployment, but they also don't want inflation. And so then what the Fed has to do is look at what can they be more certain about. Right now, unfortunately, they can be more certain about inflationary pressure than they can about a weak economy, right? We still see a GDP now forecast for Q2 of 3%, where we saw JOLT job openings actually rise in April. I don't think we should overinterpret those as the economy is really strong, but I do think that they make it hard for the Fed to justify cutting rates at this moment.
But Betsy, this inflationary pressure is coming from a conflict, and it's energy driven. Isn't the Fed historically, haven't they been taught to look through this?
I love this. I feel like I was like in my econ macro class and a student was like, hey, we're supposed to look through this. You're 100% right. But there's one problem. We had high inflation in 2021, and we have a public that is on tender hooks, worried about inflation. What that means is that inflation expectations may not be as well anchored as we need them to be in order to look through a brief period of inflation. So what the Fed has to be looking at is, you're absolutely right, not what is the transitory inflation that's going to pass through very quickly, but what's the potential for that transitory inflation to become sticky, either because it takes the conflict a while to resolve, or because inflation expectations are not well anchored.
Betsy, well communicated. Thank you. Betsy Stevenson there of the Ford School at the University of Michigan. That last point I think is so important. The way a policymaker looks at price pressure and the way the consumer experiences it is so different. The policymaker might look at month over month the base effects, and they'll say things are transitory. Because of the base effects, you'll work your way out of this in the next 12 months. It won't endure. The consumer's experiencing the accumulation of price pressure over a period of time, which is why they feel so downbeat about this economy right now. It's not about where we are at this given point. It's how we got here over the last 5-6 years.
And the fact that people have gotten accustomed to prices moving around quite a bit, because they have been moving around quite a bit, gives companies a bit more leeway to kick up prices a little bit higher. I remember what Mohamed El-Arian said, which is in board meetings, they took the sticker off of some of the products they were selling that had $1.99 or $2.99 that had the price on it, suggested retail price, so that there could be more flexibility in real time.
You could have 1% inflation year over year. It would not make a difference to the consumer because price pressure has built so much over the last decade.
Yeah.
It's not going to move the dial. It really isn't.
If the Egg McMuffin now costs $8 rather than $4 or $3, you know, Houston, we've got a problem. Allowance is going up.
McDonald's is not cheap in New York City, is it?
You know,
it's not cheap food.
It really isn't. But you know, then if you have it doesn't. But I think that the role that the offspring buys in the morning, the inflation gauge has gone up, as has the allowance request.
Do what we used to do: get a bowl of cereal, right? You know, the expectations have risen so much in the Abramowicz household, right?
I bet it's one of those. I bet it's one of those like bacon, egg, cheese. Add the avocado. That's another $1.50
from the food cart. But yeah, that's right. I'll just get Lucky Charms.
And a slice of toast.
Yeah, I can't wait to hear what you have to say about that.
Talk about that later. Let's get you an update on stories elsewhere this morning. Cattle feed for humans. You know that.
We'll wait till later.
Yeah.
Actually, right now.
Your Bloomberg Brief with Isabel Lee. Hey, Isabel.
Hi, John. JP Morgan's Jamie Dimon pitching the SpaceX IPO to thousands of the bank's high net worth clients today. According to invitation seen by Bloomberg, Dimon will host a, quote, live interactive discussion with SpaceX executives. The company is looking to sell over 555 million shares at $135 a piece. Netflix is using AI to personalize content for its customers. Speaking at the Bloomberg Tech Conference, the streaming giant said it plans to integrate generative AI to its platform. It hopes to gauge the viewer's mood and tailor its recommendations. And in sports, the New York Knicks are 3 wins away from their first title in 53 years. The Knicks beat the San Antonio Spurs in the Game 1 of the NBA Finals, 105-95. It was New York's 12th consecutive playoff win. Game 2 tips off tomorrow night in Texas. That's your Bloomberg Brief. John?
Very cool. Thank you, Isabel. Thank you very much. Partial to some muesli sometimes.
Oh, my gosh.
But the broader array of cereals doesn't quite.
Okay, all I can say is Jonathan Ferro. He should eat cereal. Jonathan Ferro. That's cattle feed for humans. Jonathan Ferro. Maybe muesli.
Muesli might do it. Just thinking,
have a good time.
I know the younger one hasn't left for school yet, so I'm just, trying to help him out.
Encourage that for muesli.
A little bit.
I'm sure he's saying thank you very much for the muesli recommendation.
Save mom some money.
Oh, yeah.
Up next on the program, still waiting on a deal.
The Hormuz Strait will open immediately upon signing. Now, that's subject to a couple of areas being cleaned out also of mines, which we don't think there are any. So it'll happen very quickly.
We'll catch up with the former White House senior advisor, Amos Hochstein, in just a moment. Stocks pulling back here. We're down by 0.5 on the S&P. You'll notice Broadcom in the pre-market new session lows down by more than 15%. The Nasdaq is down by 1.3%. Let's talk about geopolitics. Under surveillance this morning, still waiting on a deal.
The Hormuz Strait will open immediately upon signing. Now, that's subject to a couple of areas being cleaned out also of mines, which we don't think there are any. So it'll happen very quickly, and we'll take the southern route anyway. But immediately upon signing, we open up the Hormuz Strait.
So here's the latest this morning. The president reiterating an agreement with Tehran is imminent as the House voted in favor of a war powers resolution to halt further action against Iran. The former White House senior advisor Amos Hochstein writing in the Financial Times, there is one solution to all of this. It's not military, it's diplomatic. And the clock is running. Amos joins us now for more. Amos, good morning.
Good morning.
How do you think this one ends up?
Well, I was trying to figure out when you showed the video just now of him saying the straits will open immediately upon the deal, and I was looking for a date because I thought that that's what he said 2 weeks ago or 5 weeks ago or yesterday.
April 17th, the strait was reopening.
So, look, we're in this. If I were anyone watching this, I would say ignore all videos and all news because it's all BS. There's no real talks towards. There are real talks, but you won't know that you're there until you're there. And so this is just market management and so on. And I actually think the market should just ignore it. Ignore the war. We've had a ceasefire. It's been in place for weeks. The straits have not opened, despite the fact that we have a ceasefire. We have flare-ups every once in a while. I mean, think about it. Iran fired at the Kuwait airport.
The pictures are shocking.
Our ally, where we have military presence in Kuwait near the airport. We have the U.S. military presence. They shot at Bahrain. And we're saying, no, the ceasefire is still intact because ceasefire definition is that we shoot at lower volumes, I think he said.
I thought that was fair, Amos, so I don't know about you.
I've negotiated a number of ceasefires in my life. We've never accepted, but you can still shoot. That's sort of the tenet of seize the fire. But so I think it's all fine because we have about 4 weeks or so still of buffers for the economy. Then they go away. So this is sort of, it's very binary.
I think the president's point on the ceasefire is that given the region you're in and the neighborhood, the shooting in a more moderate manner is what he's meant. It basically suffices for how they feel right now. But I'm totally with you. It's not clear to me what would it take for this administration to say Iran has crossed our red line in terms of a ceasefire. But when it comes to this summer, the president to the New York Post said potentially the strait won't open, the blockade won't lift until September.
Yeah, I don't think that's real because we're acting as though the crisis is not affecting the energy market because we have enough, which is true. We actually do. The market's working the way it's supposed to. After the 1970s crisis, we said we need a lot of inventories. So we created the SPR in the United States and Japan. We created commercial stocks. But those are all drawing at historically high levels, and they're not renewable, okay? They are finite. When they run out, they don't exist anymore. And so we know we have a roadmap of when that will happen. Some of that will happen at the end of June, early July, and the SPR probably mid-July. That's the timeline that the administration has to reach a deal. After that, they can't. After that, the leverage is gone.
You worked for Biden, and you were really the energy czar for the Biden administration, and we had the highest gas prices this country has ever seen, north of $5 a gallon. Will Trump now own that, you think, this summer? Will he surpass that?
I mean, look at his polling numbers. He owns it now, not this summer. It's $5.03, June 14th, was the highest price in 2022.
Well, we're not there yet.
We're not, but we reached $4.50.
They deployed the strategic midterm reserve. Do you remember?
Yes.
Do you remember?
And I expect that to happen
I'm
with
sorry,
this administration.
are we now in June and it's the midterm? Here's the difference. When we deployed it, it brought down the prices to below $4 by August. So we already knew where the solution was because we didn't have a disruption. Now, if you continue this for a few more weeks, what do you do when the SPR is not available to you anymore?
What are they going to do?
Well, I think at some point they'll probably look at restricting exports. They'll look at all the things that we talked about.
But that won't actually work.
It will work to some degree if they do not banning export, restricting. But again, this is if they don't reach a deal. I think they will reach the deal before the timeline. I said that the president says September it won't happen because he'll have to reach a deal before, because that's when you're near the energy cliff. And it is a cliff, guys. This is not a we think. We know if you reach the tank bottoms and you can't take out. So we're not living on an increased production. The United States has not increased oil production at all in this war, because every day you tell them, oh, guys, put $1 billion in the ground, but the war is about to end in the next 24 hours and your $1 billion is wasted.
We talked about this with Chevron. They're increasing production as much as they can currently, and they are exporting a lot of it to European allies. Do you think there'll become a time where they'll stop exporting to international allies?
Why would they? You're getting a higher price. Remember, Brent price that you see on your screens here on Bloomberg are not real. Those are fake prices. That's computer screen prices. You can't buy a barrel for that price. Brent is not selling.
Well, how much can you
at
buy a
95.
barrel for now?
Probably 120. So in the physical market, to get those barrels, it's much more expensive. So if Chevron sees I can sell a barrel for more, why would I sell it domestically? That's why they're exporting. But also increasing as much as they can. They're right, as much as they can, without increasing CapEx that is going to be risked by the war ending. So if you tell producers the war is about to end, why would they increase production? We have only increased production 300,000 barrels in the last year. So we haven't actually seen any increased production. So what are we living on? We're living on inventories, on a buffer. And the buffer gets smaller. And the market's right to say, okay, but I don't need it to be a crisis right now because I have the buffer.
Yeah. And then you get this non-linear move and things change. And I imagine the negotiations will change pretty quickly too, Bramo.
Yeah, which is the reason why Amos says it's not realistic to get to Labor Day.
Do you not like that? The Strategic Midterm Reserve? It was a good name for it at the time. No, it didn't work for you.
But the same people who called it that at the time, I don't know, we're again in a midterm year. So I'm a bit confused by the 2022, May, June. Now we're in May, June 2026.
You know?
It's not fair. I'm just confused.
One day Biden was coherent, and now people say he wasn't. You know, people figure things out. Alex, it's good to see you.
Yeah.
Alex Hochstein from New York. This is Bloomberg.
It's all about AI.
We're still seeing a lot of strength and a lot of momentum around the AI trade.
Since March, we haven't seen anything that resembles anything sort of a pullback.
Demand is showing no signs of slowing down.
Records will be broke over the coming weeks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. In your price action, your scores look like this. Equity futures pulling back by a third of 1%. On the NASDAQ, down by more than 1 percentage point. One single name in focus, Broadcom. In the pre-market, down negative by 15%. Following earnings.
Yeah, people point to the fact that revenues and the projected sales didn't come in as high as some of the highest projections on the street. Still, they did improve their estimate for the full year. This just highlights how much we've baked into some of these names. Outperformance needs to be met by incredible beats in the earnings, and if they're not, the punishment comes.
Look at this from Jim Reed over at Deutsche Bank. 2-month change in the S&P 500 since World War II. He put out a chart. Contact Jim, get hold of it. Fantastic picture. We've only seen gains like this rapid, coming out of recession or before the big market crash of 1987. Moves this big, like we've seen off the lows of March, are pretty rare to almost unheard of over the last few decades.
We were talking yesterday about how if you made it day 10 in terms of the daily winning streak, it would be the longest streak in the S&P 500 going back to 1995 or 1996, that kind of era. That's the reason why it is rare, is because it tends not to be continued, considering the fact that people start to get worried about elevated valuations. This is different in the sense that the earnings have been there, and that's the reason why the one thing that would make Max Kettner over at HSBC bearish is if you do see earnings start to roll over or the supply of chips start to exceed demand once more.
It was also CrowdStrike yesterday. CEO sounding so optimistic. The worlds of cybersecurity and frontier AI collided. This was the mythos moment, he said in the press release. AI security infrastructure, critical to success of AI adoption. You are talking about the need for this type of technology everywhere, and yet disappointment.
So stocks are a bit softer this morning off the back of that. We're down by 0.4% on the S&P 500. This hour, we shift towards the economic data at 8:30 Eastern Time. We get US jobless claims, and it follows a string of better than expected economic data through the week so far. Manufacturing, the ISM at the headline level, good. Job openings exceeding all estimates on Wall Street. The ADP in line north of 100K just yesterday. And claims have been a snooze for all the right reasons now for more than a year.
Yeah, this has been the low hire, low fire dynamic. That said, all of those metrics that you just mentioned, including ISM services that came out yesterday, there's some hair on them. And this is what people keep talking about. You take a look at the employment component of all of these metrics, not great. When you take a look at the JOLTS number, it looks fantastic on the headline number. It looks fantastic in the ratio of unemployed Americans. And then when you take a look at the number of people who feel free enough to quit their jobs, typically a metric people look at, that actually went down or came in beneath expectations. So again, it goes to the confusion of what actually is happening under the hood.
We can do our part to foster confidence, to get people to feel good about the labour market so that they do think about switching jobs for...
And asking.
That's the data point I always look for. Nita Richardson joins us later. Always ask about job switchers and the pay bump that you get from switching jobs. Decent sign of just how hot this labour market might be, or not.
Yeah, and you have seen that tick up in certain sectors. You also have seen people who stay get some wage growth. So, you know, there are lots of different
things.
things.
Some good news, Bramo.
Yeah, this is great.
Get a pickup in wages.
And you always say that economists are the worst. Because who's
they are
rooting
the worst.
for people who do not
Economists are
get...
the only people on the planet who worry about hotter wages.
Well,
right?
Yeah, well, yes. But they're doing it because of what Betsy Stevenson said, which is that workers have to pay the prices on the other side, too. And if the prices are going up faster than their wages, that becomes a problem.
Prices paid in the ISM yesterday, the highest since August 22.
There you go.
Prices paid pretty hot on both the manufacturing side and the service side as well.
Yeah, and understandably, if people can keep up with those prices, that's a good thing. You want people to be able to afford their lives. But if they can keep up with the prices, those prices can keep climbing. And that is the concern by economists. Not to defend them, but that's exactly what people
Wage price spiral is a scary thing.
Exactly. Frightening.
To nobody else.
Exactly.
But economists. Coming up, Tracy McMillan of Wells Fargo. With stocks pulling back from all-time highs, Andrew DeGasperi of BNP Paribas as CrowdStrike misses the high bar for software. Nita Richardson of ADP joins us a little bit later. I'm right there with you, of course I am.
No, you're not.
Come on, of course I am. We begin this hour with stocks edging lower after Broadcom results call off the record-breaking run for chip makers. Tracy McMillan of Wells Fargo with a year-end target on the S&P of 7,500, expecting no Fed rate moves, a better economy and increased M&A activity through to year-end. Tracy joins us now for more. Tracy, a wrinkle this morning, and good to see you. And that wrinkle comes from Broadcom. What's the lesson from the price action this morning?
Good morning, John. So the lesson is that after such amazing run like we've seen in the AI names, there is still some room for disappointment. So we have overweighted information technology, but we're telling investors not to chase those names at these prices right now, and that there are probably better opportunities in some other sectors like industrials or utilities or even financials.
Well, you've liked financials. That's been a high conviction call. And Tracy, it hasn't been working. Why hasn't it been working, and why would that change?
Yeah, so it hasn't been working because of the steepening yield, the flattening yield curve and the private credit issues. And we think that going forward, we are going to start to see that yield curve steepen some. Right now, there are a couple of rate hikes priced into the markets. We think those are going to come out by the end of the year. And we also see some additional potential upside in rates on the long end. M&A activity, you mentioned that as well. IPO activity, both really good for investment banking. So all of those things we think support financials.
We were talking about concerns around private credit. We're getting another headline this morning. The Blackstone Private Credit Fund plans to cap investor redemptions at 5%. This comes amid a slew of different information that we've been hearing, including from the Swiss Partners Capital we were talking about earlier this morning. Does this give you pause, or do you think that this is noise, given a duration mismatch and not necessarily a broader signal about the market?
Yeah, so we think that that is not necessarily a broader signal about the market. We're watching spreads in the public markets that are at near record tights. And so we don't see broad concern in the fixed income markets. That said, there are some pockets in the private credit market that obviously investors are starting to worry about. And so we would tell investors that it's important to keep that diversification within a fixed income portfolio, with some potentially in private credit if that fits their risk profile. But in the public markets, we are just not seeing that strain.
There's also an issue of consumer spending with their wages not really keeping pace. We just saw credit card balances hit a record $1.28 trillion. On the margins, delinquencies picking up. Do you see signs the consumer is getting tired? Does that give you pause?
Yeah, so definitely there is a component, a segment of the consumer that is starting to get stretched, get tired, if you will. We've talked about, the higher prices that they are experiencing. And so they continue to spend, but some of that spending is now coming from savings. Some of it's going onto credit cards. And I think the positive here is that it's not all consumers, and we are continuing to see, some firming in the labor market. And as long as consumers have jobs, they can continue to spend. And really all we're expecting from the consumption part of GDP this year is maybe a modest improvement, because most of our GDP expectation is coming from CapEx.
Tracy, what do you think about the energy space right now? I noticed in your note you said you want your investors' portfolios to trim energy equities and commodities, but we just heard from Hochstein, who basically said we're living right now globally on a buffer. And when that dries up, we could see tremendous upside when it comes to energy prices.
Mm-hmm. Yeah, so we are telling our investors that it is a source of funds for some other areas of the market where we see better valuation. So we're not necessarily disputing the fact that, almost 1 billion barrels of oil have been lost through this conflict, and that there are going to be some pockets of the global economy that are going to start to experience severe shortages if we don't get oil flowing again. That said, though, we do think that when oil spikes, that it is an opportunity for investors to reposition, because we don't think this is a long-term supply issue. It's a supply shock.
Is this basically investors needing some capital to allocate elsewhere, maybe with some upcoming IPOs? Where else do you see investors moving money around to make sure that they are getting in on the AI race?
Mm-hmm. Yeah, so we definitely think we see that happening. We have seen the Mag 7 starting to underperform. We've seen crypto underperforming. And so we think it's some of those higher beta areas of the market where investors are pulling funds, raising cash, so they will have that cash available as these big IPOs come to market through the summer.
Tracy McMillan of Wells Fargo. Tracy, thank you. Appreciate it. Still constructive on this equity market. Financials not working really at all. There's lots of reasons for the bank's trade to work. Hasn't really picked up. It's been a stop-start story through the year so far. And this story for the broader financials, from the private credit players, that story's not getting better.
No.
For the names, at least, for the individual stocks, they've struggled to get off the mat.
Yeah, and investors still have a desire to withdraw more than potentially the funds can handle without affecting their other shareholders. This particular Blackstone private credit fund saying that repurchase requests exceeded about 10%, or were about 10% of shares outstanding, and they will only fulfill about 5% of that. And we've seen this practice pretty much across the private credit retail-focused sector.
Just a cloud hanging over the stocks through the year so far. Equity futures on the S&P pulling back by just 0.4%. With an update on stories worldwide with your Bloomberg brief, Isabel Lee has more. Hey, Isabel.
Hi, John. Dallas Fed President Lori Logan says the central bank may need to raise interest rates later this year to bring inflation back to its 2% target. Logan joins a symphony of Fed officials highlighting inflationary concerns and raising the prospect of rate hikes. Broadcom shares falling in pre-market trading. The company delivered a disappointing forecast for AI chip revenue. Broadcom says it's making progress with AI customers, including Alphabet, Anthropic, and Meta. And some members of the Glazer family are debating whether to sell their stake in English football club Manchester United. After more than 20 years of ownership, some family members are trying to convince others it's time to sell. That's your Bloomberg Brief. John?
Isabel, appreciate it. Thanks for the update. Up next on the programme, the Morning Calls Plus, Andrew DeGasperi of BNP Paribas as CrowdStrike fails to meet sky-high expectations. That name down in the pre-market by 10%.
The demand environment looks extremely good still. Valuations actually still look pretty good, especially on Broadcom's side. They remain very entrenched in the key players out there within the AI ecosystem. And as a result, I think this is a place you still want to be, acknowledging, though, that there are risks that are heightening.
That was Angelo Zino of CFRA. Equity futures this morning look like this. On the S&P 500, down by about 0.4%. On the S&P, on the Nasdaq, we're down by 1.2%. Broadcom weighing on this equity market this morning. More on that a little bit later. In the bond market, Treasury yields shaping up as follows. 2s, 10s and 30s, yields down across the curve. We're down 4 basis points at the front end of the curve. Heading into jobless claims, 15 minutes away.
And jobless claims have been basically a straight line. It sort of looks like what you would see on Scrubs if someone did pass. It seems like we haven't gotten a real signal here. Do we start to see anything in terms of either tightening or potentially loosening ahead of tomorrow's key employment report?
Looking forward to that. Payroll's just around the corner. Looking for something around 80 to 90K. 80 to 90K, we've said that a few times already this morning. Break-even rate for this economy. Some debate about the estimate around that, but closer to 0 than 100. So anything north of 50 right now is going to be taken pretty well.
Yeah, I really do think that people are going to ultimately look at the unemployment rate and the wage growth figures, because those are going to be the biggest tells about how much inflationary pressure, the wage price spiral that only economists care about, and me, by the way, in terms of perpetuating any kind of inflationary pressure.
I'd love to see a wage price spiral.
Same. I was like, I'm excited.
Right,
Hope it happens. Yeah.
Bring it on. Let's get you some morning calls. First up, Bramo doesn't want one, just for the record. Macquarie, downgrading Broadcom to neutral, expecting market share to decline meaningfully as Google moves to insource its chips. That stock is down by 15%. Your second call from Citi, raising its price target on Oracle to $330, expecting the company's cloud strength to continue. And your third and final call from Citizens, hiking its price target on CrowdStrike to $780 from $550, saying it's a retail opportunity for a household name in cybersecurity. We appreciate that you're doing your part.
She's like the adult in the room.
Yes, I think, thank you.
I personally don't want to see prices go to pandemic levels. I don't want to see my toilet paper
so you're going to do your bit
and be $15 for two rolls. I think that's not necessary.
Where are you paying $15 for 2 rolls?
I'm saying I don't want that to happen.
Oh, right, OK. Your year-end eval must be fun. Must be so easy for management.
All right, okay.
Okay.
It's like positive for me, negative
Let's
for me.
get to CrowdStrike. Andrew DeGasperi of BNP Paribas has a neutral rating on the stock with a $400 price target. He writes AI should be a catalyst to cyber demand, but the stock is not attractive on current growth expectations. Andrew joins us now for more. Andrew, good morning.
Good morning.
Good to see you, sir. Let's just start with this massive rip off the low before we even get into today's declines. We're talking about a name that's up 100% from the lows of the year.
That's right.
Why has this become the sweet spot for software?
Well, I think at the beginning of the year, we had a lot of the kind of leaks in terms of the AI companies, the AI labs, essentially saying that they'd be disrupting certain segments of software. And cybersecurity actually was one of those that were flagged and leaked into the press. What was interesting is that after the announcement that essentially Anthropic was going to partner with the leading cybersecurity companies, that completely changed the entire narrative, because prior to that point, cybersecurity was considered a disruptible sector. After that, I think it was viewed as one of the key sectors in order to protect all of us from potential bad actors in terms of disrupting the economy or anything in that regard, with tools that are essentially very advanced when it comes to how to hack organizations.
So the narrative improves, the stock gets squeezed because it was beaten up so much, and now you've got this spread between the narrative and growth expectations and growth. How do we close that spread? What are you expecting to see from the company?
Yeah, so at the end of March, there was a completely change in terms of tenor from customers. I think the CEO of CrowdStrike has mentioned that as well on the earnings call last night, saying that he saw a massive inflection point in terms of tools that could protect against AI, essentially. So in order for companies to deploy AI internally, they would need to adopt a lot of tools like CrowdStrike. So what happened is essentially the company is now, and this is probably ties into the improved optimism on their part in terms of the pipeline, is that a lot of customers are essentially asking for the tools that CrowdStrike offers, among others like Palo and others. But I would say CrowdStrike in particular last night was vocal about it.
At this point, how do you gauge whether we've already priced in all potential growth and versus still have more room to go, and this is just a temporary blip as people are used to a much bigger outperformance from other tech-related names?
Right. No, that's a good question. And I think one of the issues is right now the stock is baking in a lot more than what is currently the street estimates for growth, right? And I think part of that is the enthusiasm behind the potential demand that would come from what's called AI detection and response. And I think we believe more like, look, we need to see the actual revenue coming in before we would get excited about the growth trajectory. Right now, and this was the title of my of BNP's note this morning, was Mythos Moment or Aggressive Guide, mainly essentially saying, look, like you have to either believe or you're going to have to wait and see. And we're more of the wait and see camp before we kind of get excited. And essentially, you have to really put some of the most aggressive multiples on software on this stock in order to be really optimistic in terms of the performance. And that's where we need to obviously have more proof before we go there.
What does it say about the amount of leverage being built into some of these names? And I'm not just talking about borrowing money, but I'm talking about levering up the expected returns over the next 5 to 10 years when there's very little visibility? Is it getting to a place that's getting a little too heady for investors?
Right. So at BNP, we essentially looked at several stocks that we considered a kind of AI winners, right? And some of them cover chip design, some cover cybersecurity, very few in software. You guys just talked about Broadcom, for example. Like all these stocks have kind of been moving in one direction, while a lot of the other software stocks, for example, have not. So I think when you look at how does that shift, a lot of it is going to be outside of these companies' like own strategy and control. A lot of it is going to be what happens, for example, with the hardware versus software trade. I think a lot of it is going to also depend on what the AI labs do, particularly as they go public. So we think that a lot of the expectations versus actual results will be different versus how these stocks perform. I think the valuation versus fundamental dislocation is widened, frankly. And so when it comes to how this how does the gap narrow over time, that's the question.
Is that why you have a $400 price target?
Well, we did upgrade it last night a bit to over 500, so we're not.
At $675, I think, even with the stock down 10%.
Right. So again, when we talked about valuation multiples, right, we're applying an 18 times sales, which is again one of the more higher multiples we apply in software land. But like I said earlier, a lot I think investors are looking at this incremental revenue that is likely to materialize over time from these security products. And that obviously hasn't materialized yet. So it's obviously the valuation is leading the potential adoption of these tools.
I'm sure you don't want to make headlines about this becoming a bubble. So I'm not going to put you on the spot.
That's outside of my scope.
Of course. But as an analyst who's seen a lot of things and been in the market for a while, how unusual is this moment to see this market get away from analyst expectations in the way it has done in the past few months?
It doesn't happen that often, but I think in this case, some people are considering AI similar to how like the cloud companies emerged like 10, 15 years ago and what happened to the industry at that point. So it's definitely an inflection in terms of change and from a technology standpoint. And so a lot of investors are struggling to understand how does this play out, of course, right? But I would say it's unusual. It happens maybe once every 10 years. So I would say how this plays out, I don't know, and I won't give you a forecast of if it's a bubble or not. But that's where we are.
What if for CrowdStrike this is a mythos moment? What's the upside potential?
Well, I mean, the TAM would be, I think, look, this is CrowdStrike's management team in terms of how they explained it. They think it can be as big as the endpoint detection and response market, which is a pretty massive TAM. I mean, if you look at CrowdStrike's revenue, That's still the majority of their revenue today. I think they're planning to get to, give or take, $6.5 billion of revenue this year. So if you apply what they're saying, that this could be bigger than that, I mean, we're looking at a few $1 billion of incremental revenue for CrowdStrike. And the reason why companies like CrowdStrike or Palo Alto Networks or Zscaler are playing that role is because AI labs can't detect these threats in real time. You need to have very accurate way to detect them. You can't just take probabilities or you're in trouble. So they're considered critical tools in that process. But to give you a sense of like in terms of how big it could be, could it be 10 billion? Could it be 20 billion? Who knows? One of the things is that they also said is that the market for AI security is going to be meaningfully bigger because we're not just talking about mobile devices and workstations, which is what CrowdStrike is famous for. We're talking about data. We're talking about models that you need to protect against, prompts, right? Browsers. This is where users like you and I essentially engage with AI algorithms is through these devices. So it's a lot wider, what I call threat footprint that you need to protect against.
Andrew, this was smart. Appreciate your time. Thank you, buddy.
Thank you, John.
Thanks for coming in. I'm sure you've got a busy morning ahead of you with this name. CrowdStrike down in the pre-market following a major rally, a massive rally off the lows earlier this year.
I love that, John. I don't want to put you on the spot and ask you if it's a bubble, but is it a bubble?
Well, no. I think for analysts right now, this has been somewhat frustrating. It's not something they're used to. Usually, the median target on a stock like this is above where the stock is trading. And for so many of these names, it's below. And that's a massive switch because the markets move so quickly. How do you price in an industrial revolution? I sound like Dan Ives. I'm not meaning to, but that's essentially what increasingly people are saying. No Second innings? Yeah. At 10 p.m. Do you want to pick a basketball player, something like that?
You know, going
Jalen
like
Brunson.
Running.
The Jalen Brunson of cybersecurity.
With the leather jacket. Yeah.
There you go. The opening bout just around the corner, 60 minutes away. Equity futures on the S&P 500 pulling back by 0.4%, on the Nasdaq down by 1.2%. Lots of coverage of Broadcom down in the pre-market by around 15% through much of this morning. The next stop for this market is the economic data. Jobless claims just seconds away. In the bond market, 2s, 10s and 30s shaping up as follows. Yields look like this morning, down by 4 or 5 basis points at the front end of the curve on 2s, at 4.03%, on 10s down to 4.44. Let's get you some jobs data, some claims and some unit labour costs in the mix as well. Jobless claims coming in at 225. That's the wrong kind of upside surprise. The median estimate in our survey was 215. One number just caught my eye, crossing the Bloomberg terminal very quickly. Unit labour costs for the first quarter coming in at 1.8%. That is a downside surprise. The estimate was 2.4. So that's a big downside surprise in many ways, Bramo. And that's taking some heat, I would suggest, out of this conversation about a Federal Reserve that might need to hike sometime soon. Yields down to the front end of the curve now by some 5 basis points.
If you're worried about a wage price spiral, theoretically, well, this would actually dampen some of those fears because it's not necessarily picking up at the same pace that many people expected. The expectation was 2.4% for those unit labor costs. It came in at 1.8%. You also had a slight upside surprise in the initial jobless claim. So again, that is not the right kind of move if you're looking for some sort of heat or growing strength in the U.S. labor market. So, well, this isn't screaming some sort of crisis. It definitely is dampening some of the potential inflationary pressure.
Yeah, I'm not going to freak out about claims just yet. 3-month average still around 215.
Yeah.
Anything close to 200K, things are okay. Look the other way. But the unit labour cost does catch your eye. And I know it's the first quarter and somewhat backward looking, and maybe things have changed in the last few months. I don't know. But that sets the stage for a conversation with the Federal Reserve to say, this is the data we've got. At the moment, unemployment's still north of 4%. Wage growth and labour costs don't look like they're getting away from us right now. Maybe we've got time to figure this out through the summer. So when it comes to urgency, the ECB's looking to move in the next week, maybe the BOJ as well. The Federal Reserve's just not there yet, and this market's not screaming at them. This jobs market is not screaming at them to make a move.
You see consumers still spending, but they're spending from their savings. They're not seeing their wages grow at a commensurate pace in many cases. And as a result, that is one reason why people are using the T word once again. They might call it transient, but it's essentially the same word, which is transitory. And essentially, that has been the theme. This would lead maybe more into that camp.
Can you imagine if Walsh uses that word?
That would be
first news conference
mistake.
Out the gate.
That would be a bad thing.
T word out of the gate.
No, don't do it.
What if he turns out to be right?
But just pick a different word. You know, like honestly, a moving experience of inflation.
A moving experience. Okay. Looking forward to this speech that Lisa's writing for Kevin Walsh.
I hope he's not watching.
Mr. Chairman, if you're watching this morning, good morning. Making some edits, courtesy of Bremo this morning ahead of that meeting 2 weeks away. Looking forward to that. Jobless claims 225, the estimate 215. Unit labour costs for the first quarter coming in at 1.8%. The estimate was 2.4. To discuss, Anna Wong, Chief US Economist at Bloomberg Economics, joins us now for more. Anna, welcome to the programme. Just take stock of this labour market for us heading into payrolls. What kind of labour market do we have?
It's a good it's an improving labour market. And with this upside surprise in jobless claims, I would say that most of it is due to seasonal factors. The seasonal factors expect about 5-something decline in jobs claims. And in fact, we have seen a little bit tick up in layoffs and hence the seasonal adjusted jobless claims surprise on the upside. But all in all, we are seeing decline in unemployment flows, which precedes a decline in continuing claims flows. So we're expecting in the next 6 months, unemployment and continuing claims would continue to go down.
That would be good news. One way we're trying to measure the heat, the tightness in this labour market, Anna, is just to look to wage costs, labour unit costs. Walk us through where we are right now and how much weight you would put on unit labour costs for the first quarter going into the next Fed meeting.
Yes. So first of all, unit labor cost is a very important concept. At the Federal Reserve, where I used to work, they would track the underlying pace of inflation by looking at unit labor cost adjusted for productivity trends. And the fact that it's running below 2%, and this is something that economists could have predicted, because coming into the year, we are seeing that firms don't have pricing power, and therefore the hiring power is also not very strong. But now, using the latest earning data, we are seeing renewed wage pressure growth, just a little bit, not as strong as 2021. But nonetheless, I think we can take a little bit of signal from Q1 unit labor costs that, in fact, the underlying pace of inflation was on track to fall below 3% this year.
Anna, what's your base case for rates now with the team over at Bloomberg Economics?
We're expecting a 25 basis point cut in fourth quarter of this year.
OK. Anna Wong there of Bloomberg Economics. Anna, good to see you. As always, great to have you in New York as well. Anna Wong of Bloomberg Economics, looking for better momentum in this economy, but ultimately a rate reduction at some point, maybe in 4Q later this year.
In part because of the labor pressures, because ultimately this might be a moving price increase, or it might be a mercurial price increase that we're seeing right now. Impermanent price increases, shifting price increases is one person suggested.
Who is this courtesy of? ChatGPT, Gemini? Who have we got going? A nice thesaurus on the
AI
desk?
of Bramo's brain. No, one person did suggest shifting. Please keep it coming. We're going to have a new vocabulary.
You're getting Bloomberg subscribers to weigh in on this too.
Please do.
Nice.
If you have a suggestion, please send it my way.
Nice. Nita Richardson of ADP is waiting very patiently to weigh in on this. Nita, good morning. Good to see you.
Good morning.
I'll give you a pass on that particular debate. Let's talk about this labour market. How tight are things? What do you see? We had a really decent ADP print early this week.
In fact, when I saw the number, I thought immediately of Lisa, because she has been asking me for several months now, is this employment picture broadening out? Is the hiring pattern broadening past healthcare? And yes, this month it did.
Good.
This was the first month we've seen in years with this broad of a hiring pattern across 8 out of 10 super sectors. Even manufacturing, for the first time in over 2 years, saw positive job gains, and we saw gains on all size fronts in terms of the establishment sizes. But to your question on tightness, if you look at the wage data, it ain't tight yet. And so the quality of the new jobs, different beast than the quality of jobs 2 years ago. That means lower pay growth, not higher. And so when we look at job changer pay growth and we can match them with each individual for each cohort, it's down a bit from last month, 6.5%. That's not bad, but it's not something that bends in any way toward a wage price spiral.
You talk about changing in the composition of the types of jobs that are getting created. Can you give some color around that? Which jobs are being created and which aren't, that would lead to more robust wage growth?
So because we're tracking paychecks, we actually know how many hours people are working. And from that, we can calculate the part-time share of new jobs and the existing headcount for all jobs. And what we're seeing is that before the pandemic, part-time share was about 37%. It's gone up 5 percentage points. It's now 42% of all the jobs we're seeing in the payroll data are part-time. And then if you look at healthcare, the jobs that are being produced there, remember healthcare is the stalwart, is producing still the bulk of job gains. Those jobs are tending towards home healthcare aides and lower paying healthcare jobs for the sector. And then if you look at the size cohort, it's the young, the smaller firms that are creating the bulk of jobs. Over half of the jobs created in the ADP report were for firms with under 50 in headcount, and they tend to have slower pay growth. So all in all, this is a lower wage dynamic than we saw before the pandemic.
You know, you talk about part-time jobs, and it's something that people talk about when we get these jobs numbers, the job growth numbers, and they say that they're overly inflated because they reflect people getting multiple jobs. They reflect someone having to work 3 different jobs to support their family. How much is that what we're seeing in the headline numbers and, frankly, even from some of the job creation?
Well, if you look at the part-time share, that suggests that it's more than one job if you're thinking about supporting a full life, right? So I think that multiple jobs, gig work is really important. And it's not just young people who are doing multiple jobs. It's older workers. It's workers who are at retirement age and now have a 1099, a side business. We used to say back in the day, a side hustle. That's something New Yorkers are very familiar with. That is common and growing in the retirement age, older age workers. So this is not going to be an unusual aspect in a very expensive economy. Affordability is a factor, and it's leading to a lot more multiple jobs.
You know, I met a lot of Uber drivers in this age cohort that are picking up this second job. They actually are retired. Some of them are retirees, and they're finding other ways to make means. What does this say about where we are right now in the economy and inflation?
Well, it says a lot about the structural foundation of the labor market. Yes, people are working longer, but as you work longer, that labor force participation drops. And so you have this mixed bag of, yes, people have to work longer because they're living longer, and maybe you're spending 30 years in retirement. You're either bored or broke, and you need to go back and get that second, maybe even that third job or a different career.
Shouldn't people be asking for higher wages at their primary job instead of picking up a second or third?
Maybe some can, but workers lack that kind of leadership and being in the driver's seat that they had during the Great Resignation. Remember, this is still a low-hire environment. If you look at those jobless claims, if you look at the JOLTS numbers, yes, jobs openings were up in April, but hiring and quits stayed basically where they have been. People are not quitting their job. And if you ask why early career are not finding a foothold, maybe it's because their older brothers and sisters who got jobs in 2022 aren't leaving those jobs. They're not being promoted. They're not seeking new opportunities. And so that entry-level job just isn't vacant yet.
What a labour market they walked into out of that pandemic. I know they were super upset about not having big parties and stuff because everyone was locked inside, but they walked into one heck of a labour market in this country.
Yeah, although they now have a reputation that isn't great. I mean,
how many?
Well, I mean, this is the question. How many people sort of blame that generation for the quiet quitting, for not necessarily understanding work ethics, and that was part of the reason why certain people were cutting back or not hiring certain entry-level people, and they were using AI as an excuse.
They were saying paid so much money.
Yeah, they made so much money.
Decent case study of that, right?
Okay, please.
New York City. OK, for those of you that don't live in New York City.
I know where you're going with this.
Where am I going with this?
West Village.
There you go. Good. You used to go and live in Murray Hill, right? You'd do an apartment share, and now they all live in the West Village. Second-year grads on Wall Street living in the West Village, which is like, what? When did that happen?
Kind of ruining it, to be honest. I mean, maybe that's
Is that how you feel? Tell us how you really feel about the situation.
They kind of are.
That's how I'm gauging how much people are getting paid.
If they're worth it, great. I hope they set a good example for future generations that will be going into the workforce in 4 years.
In defense of Gen Z. It's hard to learn the skills of work without being onboarded. And a lot of them are onboarded in a remote hybrid work environment, and they don't get the peer and the older peer mentorship that leads to good work habits.
Drew Mattis shared research from the New York Fed this week that said youth unemployment has risen dramatically since the pandemic, and it's not about AI. It's because they're at home and they're working from home and they're not getting the mentorship as you described, and that's why there's a rise of youth unemployment.
But is that because they want to work at home or because their superiors don't want to work in the office?
It's probably a mixed bag, but I think maybe, I don't know. I hear a lot of Gen Zs that love the idea of scheduling their schedule to them not their employer.
Nita, it's good to see you. It always is. Thank you. Nita Richardson there of ADP, just holding on to a better jobs market, just a bit of momentum there, some broadening out.
I liked her defense of Gen Z. I'm going to run with that. The idea that they weren't mentored, they weren't brought into something. They were psychologically devastated from the pandemic of graduating into a social void where you really couldn't experience one another. And then they were foisted into work environments where you didn't get the normal discussion. You didn't get the vibes of an office, of the water cooler. That's hard.
Yeah. Thank you. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Isabel Lee has more. Hey, Isabel.
Hi, John. Recapping the data we just got, jobless claims coming in at 225,000 last week, well above estimates of 215,000. Continuing claims coming in at 1.77 million, ticking down slightly from the previous week. Another setback in U.S.-Iran peace talks, the Hezbollah chief saying the Iranian-backed military group rejected the ceasefire deal between Lebanon and Israel. He says the agreement must include all of Lebanon. And Blackstone Private Credit Fund hitting its quarterly redemption gate in the second quarter. It's now capping withdrawals at 5%, despite investor exit requests hitting 10%. The news comes after Partners Group announced it will curb investor redemptions in more of its private equity funds. That's your Bloomberg brief. John?
Isabel, thank you. I guess I've got to come back to it.
Oh, no, really?
I've just got to squeeze it in a little bit.
Okay.
The generation that won't pick up the phone and you think they've been starved of the conversation in the office.
Part of it is because they haven't been forced to engage in social circumstances. I can't talk in abstractions. I know that it's not quite the difference. That I see a different Gen Z at home.
Okay.
It's not
Things
as
are better.
stunted. I see their friends. I'm optimistic. There's some wonderful, wonderful people coming to the workforce.
I totally agree with. I completely agree with. We're talking about a very specific cohort that graduated
the
at a very
music is still
specific
playing.
time. I know, because I've got to go. I've got to go.
Okay, let's go.
Just explaining myself. Set you up for the day ahead. We'll do that next. We'll catch up with Kelly Kowalski of MassMutual on the further risks to the chip rally.
The question that I'm trying to figure out, are the impaired stocks or the impaired groups, are they weak because they're truly impaired, or are they weak because they're just not AI stocks? And I think that's the big question of the moment, because we've been in this highly rotational market. I think that continues, but you do have to just be aware of some of these little cracks around the edges.
That was Chris Ferrone of Strategas weighing in on the equity market a little bit earlier. Got this message from Kevin Gordon of Schwab moments ago. I'm Gen Z and I come in peace. I don't consider Kevin Gordon part of that generation, do you?
No, he is absolved from any Gen Z associations after the conversation.
We're talking about this very specific class of Wall Street. Do you remember that presentation at Goldman by that first-year analyst?
Yes, I know what you're talking about.
They put a deck together for partners at Goldman about how they were overworked.
There is an issue, and I will just say, it might be a generational thing of people who grew up on Instagram doing things and believing themselves to be more inflated, and sort of the vision that you can craft for yourself online being similar to the amount of work that has to go into it.
I also think it's a massive opportunity for anyone of that generation to separate themselves from the pack, because you just have to act.
The bar's low.
Right? A certain way, turn up to work first, stay late, be in the office all the time, meet with that old school manager, that boss that's always there, never takes vacation. You know what I'm talking about?
I do.
Right.
I think, what I love about this is you're clearly talking about someone. Who are you talking about?
Futures are negative by a third of 1%. Let's get you some single names. Some stock movers this morning. Yahara has more. Hey, Yahara.
Hi, John. Well, the AI trade is under pressure this morning, and at the center of it is Broadcom. Those shares down 15% in the pre-market as investors zero in on an AI chip revenue outlook that just did not meet the lofty expectations. That's because investors added some $270 billion in market value on this stock in just the past 5 sessions, leaving little room for error. And that weakness is dragging down the entire chip trade. We're seeing names like Intel, SanDisk, and ARM down in the pre-market. And remember, these are the names that not just helped us, that lifted us in this 9-day rally that ended yesterday, but also lifted us from the lows of March. And we end on On CrowdStrike, those shares also falling in the pre-market at 10% after its outlook failed to impress investors. The outlook largely matched, but it failed to justify a stock that has surged nearly 60% year to date. John?
Yahara, thank you. Appreciate it. One final point. Can I make one final point? It's actually in support of that generation.
Oh, good.
This, I think, is the strongest argument. I don't think the upside potential exists for them in the way that it used to, and at least that's how they perceive the jobs market right now. Let's take Wall Street as an example. The years of the crazy bonuses kind of in the rearview mirror. I think back in the day, if you did that hard work, there was a path there that you could see with visibility to some real gains. You could accumulate that wealth through the stock market. I think that they feel like that's beyond them, that they have to take these other risks elsewhere, crypto, YOLO names, meme stocks, all of those kind of things. That's kind of what I'm getting at that point. And I understand where that comes from.
Companies don't have commitment to them in their careers. They don't think they're going to have one career their whole life. They think they're going to have lots of different careers. They aren't getting jobs. I mean, how many graduates are moving back home with their parents and have no options for anything? So I don't know. I haven't seen that level of, badness.
That's why I have a lot of sympathy. Jim Bianco just writes in, when did you guys become the get off my lawn complaining boomers? Hey, Jim, don't get me started on the boomers.
Yeah.
So I've got strong feelings about that too.
So do I. All right.
As we count you down to the opening bell, let's check in on the AI rally. Grinding to a halt, the chip makers coming under pressure. Kelly Kowalski of MassMutual writing, investors should stay the course, but FOMO behavior, bottlenecks, CapEx discipline, and efficiency gains are risks that should be monitored. Kelly joins us now for more. Kelly, good morning. Good to see you.
Good morning.
We'll avoid all of that. Are there cracks emerging in this trade?
I don't think there's cracks. I think this is more about too high of expectations versus the fundamental long-term story. We've been accustomed to revisions of 50%. If you look at sort of the Gartner forecast for memory chips for this year, for revenue, it's 3x. Next year, that's expected to slow to a 20% growth rate. So we're kind of in the joyful part of the parabola, but I think this sort of, this modest sell-off we're seeing is a bit healthy because it's kind of resetting some of these expectations.
Is it enough to get back into some of these names?
We wouldn't recommend chasing the parabolas, but we think you have to stay in the market, stay diversified. The risk is really being underweight this long-term secular macro trend.
How concerned are some of your investors, are some of your clients, about just how quickly things have shifted and their inability to keep up, their inability to sort of wrap their heads around some of the numbers that we're seeing coming out of IPOs or even just the debt raises?
There are some signs of froths, a little bit of signs of euphoria that we're seeing. If you look at retail call buying, maybe some of that is Gen Z trying to get in on that trade. You're seeing some of that, but at the same time, you've got the fundamentals that are supporting it through the earnings side. So I don't think we're at peak growth or peak euphoria yet, but there are bubble-ish things coming up. We don't think AI itself is a bubble. It's a wave that's going to crest and fall. But we should be on the lookout for overexuberance.
How excited are people about space?
Well, I think if you look at sort of the SpaceX IPO and how much the valuation is, there's a lot of excitement out there. You look at the ETF flows into some of these new space ETFs, there's excitement. But again, going into the IPO, excitement. Look back decades ago to Facebook. You had some negative returns post that IPO. So it just really enforces for us the importance of taking a long-term view and really looking at the broader trend versus sort of the immediate excitement.
Kelly, are there some things about this particular moment for SpaceX that remind you of that moment for Facebook?
Perhaps.
What stands out to you?
I think it's hard when Facebook IPO'd, it's hard to really just wrap your mind around the future and, the trillions of dollars of market cap that they would capture, right? I think if you look back at that moment, no one sort of saw how much ad revenue they would capture and how dominant they would be with billions of users. And I think you kind of have that same paradigm with when we're talking about data centers in space, for example. None of us can wrap our minds around that, right? That sounds very far-fetched, and perhaps right now it is. But looking into the future, a decade or two, maybe it's possible. Again, it really comes back to the long-term view and thinking about it in that way.
Kelly, it's good to see you. Thanks for being here. Thank you. Kelly Kowalski there of MassMutual. The failure to imagine. If we were doing this in the 90s and we were talking about Amazon, there's no way that I would have imagined what Amazon would ultimately be in 25, 26 years' time.
Yeah, books. You thought that it was a really easy way to get books.
Why can a bookseller have a market cap this large? It makes no sense to me, because it wasn't about books.
And I remember being really skeptical of Netflix. Who's going to want to buy rent a subscription to get a CD, a DVD shipped to you in permanence? And guess what? They totally transformed themselves with debt issuance. They used the capital markets to really create a behemoth. This is why you're seeing analysts fail to get ahead of the earnings growth that we've been seeing again and again.
This was fun. Appreciate it. No doubt the conversation will continue after the show's finished. All right?
I think I'll be remote tomorrow.
Coming up tomorrow, Jonathan Golub, Seaport, Priya Misra of JP Morgan, Nadia Lovell of UBS, Jeff Rosenberg of BlackRock. From New York City this morning, good morning. This was Bloomberg Surveillance.